What is not baked in is the idea that we may actually end up needing these cuts.
Right along with everybody else, I expect a quarter-point cut.
We don't see the economy going to above trend growth. So this is a kind of a muddling through scenario.
I don't think anyone would be completely shocked by, a more dovish bias here.
If they do 25 bips or if they do even 50, the market should be able to take it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, the two-day meeting begins. The Federal Reserve getting together ahead of tomorrow's decision as White House Fed pick Stephen Miran is taking a seat at the table. A U.S. appeals court is blocking President Donald Trump's latest effort to remove Fed Governor Lisa Cook.
So if you weren't interested about what's happening in Washington, D.C., which begins today and ends tomorrow, well, this is going to be fireworks. The idea of a Lisa Cook, Stephen Miran showdown is made for primetime TV. The reality is that might make really good headlines, but the actual fireworks for markets may happen in the guidance going forward of what they plan to do with policy, of which Stephen Miran is a temporary part since he has such a short term.
We've already had the fireworks in the markets.
That's true.
Record highs on the S&P 500, on the Nasdaq 100. Bank of America out with their fund manager survey so far this morning. These are the headlines. The most bullish survey since February. Equity allocation the highest in 7 months. And this, a record. Say stocks are overvalued going into this Fed decision.
They say stocks are overvalued and they keep buying. Particularly tech stocks are overvalued and they keep buying tech stocks to a significant degree. Why? Because of rate cuts. And this hinges on the tension, the idea that you do get some sort of rate cutting cycle that gives power to the equity rally at a time where they don't see weakness. Just to give you a sense of this, if you look at the internals of the survey, it's pretty fascinating. Not only are they the most bullish on equities going back 7 months, but about 39% of respondents to the survey want companies to increase capital spending. That is the most since December. So this is a forward look into growth and optimism. It goes beyond just a one-time pop at the same time that they're clamoring for a rate-cutting cycle.
We started the week asking this question. Can this Federal Reserve meet this market? Just how far is Stephen Miran, now Governor Miran, willing to push things? Just how low is that dot going to be?
Yeah, and how much will the market care considering that his term is up early next year, right? Is he more of the noise or the signal as to who will replace Chair Powell come next spring when there is a new Fed chair? Look, this really is the question. Can the Fed confirm what's in markets, which is a rate-cutting cycle that brings Fed funds rates close to 3% or even below that by the end of next year? If they can't, how significant is the blowback, or are people going to take it in stride and find another reason to be bullish?
And if they do, will it look credible or will it look political? And that's a very, very different conclusion.
One thing that I was struck by is that one of the biggest potential pain trades is a stronger dollar. This, to me, is a fascinating moment because a lot of what we're talking about, the idea of a Fed that's easing quickly and maybe isn't as credible, but it doesn't really matter because it's going to juice growth. That story has led to this persistent weakening in the dollar. If you get a reversal of that, how violent could the pain trade be given the fact that this has been such a consensus bet?
As we speak, dollar weakness. Euro dollar through 118, 118.12 on that currency pair, the highest potentially if we close here since September 2021. Some euro strength on the screen, at least so far this morning. That's some of the price action for you. Coming up this hour, we'll catch up with Henry Allen of Deutsche Bank as stocks hit fresh record highs. Brian Gardner of Stifel as an awkward FOMC meeting gets underway. And Elias Galou of Bank of America on the valuation fears across Wall Street. We begin this hour with stocks hitting new all-time highs ahead of the Fed's two-day meeting. Henry Allen of Deutsche Bank writing the following. The backdrop remains bullish, but there's currently a great paradox in markets. Henry joins us now for more. Henry, good morning and welcome to the programme. Let's talk about that paradox. Briefly describe what is at the epicenter of this market for you.
Well, as I say, there's this great paradox because on the one hand, you've got a lot of signs of caution. So gold prices at a record high, even in inflation-adjusted terms. And we've seen clear signs of weakness in the US labour market. We've got geopolitical risks, tariffs still floating through. So a lot of sign of caution, and hence investors are pricing in more rapid rate cuts. But then, as you said, we've also got risk assets at all-time highs. The S&P 500 hitting a succession of record highs, now on track for 6 out of 7 weekly gains. And actually, US IG credit spreads yesterday were at the tightest since 1998, which is, again, portraying a much more bullish backdrop relative to those fears that a lot of people are talking about. So I think if we take out the noise and look at the fundamentals, and growth still looks pretty robust according to GDP trackers, I think we're still in a pretty good place.
So, Henry, the problem I think a lot of people have got at the moment at the payrolls data. We've had a huge step down in the payrolls data, which has led the Federal Reserve to this very moment to consider interest rate cuts. And this market, as Lisa and I have talked about, seems to be overweight rate cuts but underweight the reasons for them. Is there any reason that's going to flip anytime soon?
So I'm not too alarmed by that for a couple of reasons. One is that actually, if you look at the break-even payroll number, given Trump's moves to clamp down on immigration, actually it suggests the break-even number to keep the unemployment rate steady is as low as 60 to 70,000. So in and of itself, the fact that we've seen a slowdown isn't a cause for alarm. The other thing, and this might again seem paradoxical, is actually from the benchmark revisions we saw last week. Yes, they were very heavy, record numbers, and indeed 911,000 lower for the year from April 24 to March 25. But there is actually potentially a good interpretation of that, which is because 2024 was revised down quite a lot, actually the slowdown in payrolls that you see on the chart from 24 into 25 doesn't look like much of a slowdown at all. Actually, we're still running at levels pretty similar to last summer. So payrolls, yes, they're subdued, but actually the GDP trackers like the Atlanta Fed running still above 3% are looking on the stronger side. And perhaps one way you can explain that is actually the productivity growth is running pretty decently because persistent in this cycle, growth has been surprising on the upside.
So, Henry, this to me is the sort of potential key to the paradox. This idea of productivity allowing some sort of growth and optimism around risk assets without commensurate inflation. Yet then why should the dollar weaken so substantially if the U.S., according to risk assets, is going to be a bastion of growth?
So I think the dollar weakness isn't so much because of the growth picture, which is pretty strong. I think the dollar weakness is coming because there are genuine worries among investors about US institutional credibility and about the credibility of economic policy making. I mean, partly that's a tariff story, not just the tariffs themselves, but the fact we've had so much uncertainty and volatility in those rates. But of course, coupled with that, we've got this attack on the Fed's independence from Donald Trump. I think some of that is over-egged, but clearly Trump is the first president ever to publicly seek to fire a Fed governor in Lisa Cook. He's not the first president to try and put private pressure on the Fed, but he's the first to do it so openly. So I think that's what's generating nervousness and is leading to a bit more skepticism about US assets. Even if the growth picture is very strong, I think those worries are still at the back of investors' minds.
Do you think then, because of the growth differentials where they're at, that maybe this weak dollar story has been overplayed?
I don't think it has, because actually I think particularly when you couple the institutional credibility issue with the fact the Fed are now cutting rates and set to embark on an easing cycle, at the same time that the ECB have now finished their easing cycle, and other central banks, indeed the Bank of Japan, expected to keep hiking, I think what you're going to see is that interest rate differential between the Fed and other central banks tighten. So I can see fundamental reasons why you'd expect the dollar to keep weakening, at least on a kind of medium-term, 18-month horizon. Yes, there will be blips on the way and narrative shifts from month to month, but I think the medium-term path of the dollar is still definitely a weaker one when you couple up the fact that the Fed are cutting rates into a pretty benign backdrop, coupled with the threats to the institutional credibility and the fear that the Fed might go pretty aggressively on cuts if Trump is successful in shaping the Fed board to his liking.
Henry, I just want to stay on this and put all the pieces together. What I hear from you is this Federal Reserve is about to cut because of the labour market data we've seen recently, but ultimately you shouldn't be too worried about the labour market data. So, Henry, with that in mind, how hot do you think this Fed is about to run things going into 2026?
Well, I think that's a really big risk and something that I would be worried about if I was sitting on the FOMC. I mean, one thing I'm really struck by is that money supply growth in the US is already picking up. It's the fastest since 2022. And actually, another thing that I'm really struck by is that if market pricing is even vaguely correct and we get another 100 bips of cuts in the next year, that's coming on top of 100 bips of cuts in the last year from September to December 24. So that'd be 200 bips of cuts in 2 years. And if you look back at recent decades, almost always when you've seen 200 bips of cuts in 2 years, it's been because of a recession. You've only once seen that in a soft landing scenario, and that was under Paul Volcker in the 80s when he was bringing rates down from incredibly restrictive territory. So not a scenario like today at all. So, you throw on that scenario, which is unprecedented in modern times, of the Fed cutting aggressively, 200 bips potentially in 2 years, into a soft landing rather than a recession, and we're running a monetary experiment that we haven't been running in many, many decades. You've got to go all the way back before the Fed Treasury Accord when the Fed wasn't really independent for something like that. So it's going to be really striking. I think the risk with that is, then inflation starts to tick up more aggressively, particularly when you then couple that onto the tariffs and the fact that leading indicator inflation like the ISM services prices paid, where that's running at the moment, 65, 70, that's consistent with CPI in the fours. So then you chuck on a load of Fed easing onto that, then I'm certainly worried about inflation in the coming year.
So, Henry, if you're worried about that, other people might be excited about the prospects for gold, about the prospects for equities, something that tracks nominal GDP quite nicely. Henry, what would you be pushing into? What would you be excited about if that's the direction of travel for this Federal Reserve?
Well, I'd certainly be excited about gold, like you say. I mean, already last week we had a huge milestone because it exceeded its previous inflation-adjusted peak at the start of 1980. And that was an environment when inflation was raging in double digits, when Paul Volcker was radically trying to clamp down on inflation by huge hikes in interest rates. So the fact that we've now got this backdrop where inflation might be accelerating, there's doubts about the credibility of US institutions, interest rates are now coming down, and gold, of course, doesn't pay a dividend, so that's inversely correlated with interest rates, then I think gold is definitely the place to be at the moment.
Henry, if inflation does pick up, how much of a pain trade is that for all of the consensus trades that we're seeing right now?
I think it would be a difficult one. I think whether inflation picks up and what that means on the market front really depends on the Fed reaction function, because it will be a very different picture if the Fed can kind of look through that as they're currently doing, because inflation is still above target, yet the Fed are talking about rate cuts. If the Fed looks through that, then I think the equity backdrop could be pretty benign. But if you get then the 22 style reaction function where the Fed suddenly clock that actually this is getting out of control more aggressively, and you do see more aggressive Fed posture, potentially even them turning to hikes in 26, 27, then I think that would induce a more negative reaction from risk assets, particularly in the equity market, because a common theme, if you look at the big sell-offs of recent years, 2022, 2018, even 2015-16, is it's actually coming when the Fed is pivoting in a hawkish direction. So if inflation gets to a point, particularly if it gets into the mid-threes, fours, where the Fed can't ignore it, then I think that's the pain trade for this equity rally.
This could get messy. Henry, appreciate it. Thank you, sir. Lots to think about there. Henry Allen there of Deutsche Bank. Looking at gold up for a third consecutive session. Gold up this year by more than 40%.
And a lot of it does come on this question of what is the alternative to the fiat currency of choice for the past 3 decades, 4 decades, 5 decades, which has been the dollar. There is a real question here about that paradox, how it's going to be resolved, or whether it can just coexist with this idea of the risk rally, this excitement for the U.S., while at the same time seeing gold rally and dollar depreciate.
And stocks continuing to rally too. All-time highs coming into Tuesday. Futures up by 0.2%. With an update on stories worldwide with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Good morning, John. President Trump's economic advisor, Stephen Miran, is joining the Federal Reserve Board after the Senate confirmed him last night. Lawmakers voted largely along party lines to approve Miran's nomination, setting him up to join the Fed's 2-day policy meeting starting today. Meanwhile, a U.S. appeals court has blocked President Trump from removing Fed Governor Lisa Cook from her post for now. The 2-1 ruling came just hours before the start of the Fed's meeting, and while the decision makes it more likely Cook will attend, President Trump could still ask the Supreme Court to step in. And the president has filed a $15 billion defamation and libel lawsuit against the New York Times. Trump is accusing the paper of serving as a, quote, mouthpiece for Democrats. The lawsuit criticizes the Times' endorsement of former presidential candidate Kamala Harris and cites the paper's news and opinion articles. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, Stephen Miran gets on the board.
I will act independently, as the Federal Reserve always does, based on my own personal analysis of economic data. I plan to dutifully carry out my role pursuant to the mandates assigned by Congress. Independence of monetary policy is a critical element for its success.
Up next, the latest from Washington with Brian Gardner of Stifel. Live from New York City this morning. Good morning. Later on this morning, the 2-day FOMC meeting begins. The Federal Reserve gets together, and before that happens at 8:30 Eastern Time, the last significant data point before the Fed gets around the table, U.S. retail sales just around the corner. Bramo, a few hours away.
And this to me is important. How much do consumers keep spending? Can we just keep dismissing the negative sentiment in the sentiment surveys because they never seem to be confirmed by what people actually do, just simply what they say?
Equities keep underweight in that story, that's for sure. Positive again this morning by 0.2%. 0.2%. Under surveillance this morning, Stephen Miran gets on the board.
I will act independently, as the Federal Reserve always does, based on my own personal analysis of economic data. I plan to dutifully carry out my role pursuant to the mandates assigned by Congress. Independence of monetary policy is a critical element for its success. The Bureau of Labor Statistics data on various measures has deteriorated steadily in quality over time. I do think it is time for a fulsome examination of the process, of the regulatory process, to sort of think about where we want it to be going forward.
So here's the latest this morning. The Senate narrowly confirming Stephen Miran to the Federal Reserve, setting him up to participate in a key policy meeting that starts later on this morning. Bloomberg's Tyler Kendall has the latest. Morning, Tyler.
Hey, John, good morning. So this caps off what's really considered to be an unusually fast process by Washington standards. We know from a strategic standpoint that Stephen Miran was chosen in part because he had already been through the Senate confirmation process once for his role leading the Council of Economic Advisors, and perhaps that helped to speed things along. Worth it on that note to mention that Miran intends to take an unpaid leave of absence from that position instead of resigning it altogether, which raises questions about perhaps the longer-term impacts of Miran's confirmation, since this post is temporary and only goes until January. But I'll point out that President Trump has previously floated that Miran could be up to replace Fed Governor Lisa Cook if the administration is successful in ousting her, though they did face a setback last night. And it really felt like we were on a collision course for a moment there, because within a matter of 5 minutes, the Senate had confirmed Stephen Miran, and an appeals court based here in D.C. had ruled in favor of Lisa Cook, saying that the president cannot oust her while the broader legal questioning of her firing plays out in court. It was a 2-1 decision here by this appeals court, which ruled that President Trump very likely violated Lisa Cook's rights to due process by posting her termination in a post on Truth Social. Importantly, though, the majority opinion here did not weigh into the question on whether or not President Trump had sufficient cause to fire Cook in the first place. And we're expecting that question to really come to the forefront when the Trump administration very likely appeals this to the Supreme Court. John, at this point, that could really happen at any moment. We're expecting that emergency appeal to go straight to the U.S. Chief Justice John Roberts, because he oversees the D.C. Circuit.
That story is not going away anytime soon. Tyler Kendall with the latest in the nation's capital. To extend that conversation, Brian Gardner of Stifel joins us now for more. Brian, welcome to the show. Can you share with us how you think Stephen Miran will approach this meeting that starts later on today?
Well, I guess it's interesting because you have the economic projections coming out, so he's going to have a say in what the dot plots look like. Being a Trump nominee, I think even though he's soft-spoken, I think he's going to be a little more outspoken in his views. It'll be interesting to see if he issues a statement afterwards, especially if it's a 25 basis point cut versus a 50 basis point cut. Trump was talking about big yesterday. What if it's just 25? Does Stephen Miran then give a dissent and voice his views of why it should have been 25? So I think that's what a lot of people, myself included, are looking for.
And he might get some company on the FOMC if he did something of that nature. What's more interesting to you? How Stephen Miran votes and what his views are, or how other people on the FOMC Board of Governors responds to him?
Much more interesting what Christopher Waller does and says, because Waller's name has been floated for the Jay Powell job as chairman. And look, Waller has talked about an insurance cut. And I think most people interpret insurance as a 25 basis point cut. Cut a little bit now, wait and see, take your time, see how it all evolves. 50 would be much more aggressive. If somebody comes in on Waller's flank and says, no, we should have done 50, how does Waller react to that? How does that play in the White House? So I think the intrigue of Waller's decision within the context of the broader FOMC move is the most interesting part of this meeting.
I'm also interested in how the market responds to this and how we interpret the market moves so far. Market has pretty high expectations for a dovish tilt and an ongoing rate-cutting cycle. We were just speaking with Henry Allen of Deutsche Bank, and he said that he thinks that the dollar weakness is largely hinged to this question around Fed independence. Do you think that that's the common view among the clients you speak to?
Not yet. I think that's a conversation that I'm going to be having with clients more down the road. For now, independence really just comes up very casually. I think the issue of independence really plays out longer term if inflation it remains sticky where it is, or firms up even more, becomes even more of a problem, and the Fed is forced to pivot later away from a dovish stance back to a hawkish stance, what does a new chairman do? This is not a Jay Powell question. This is a question for Jay Powell's successor. So that's when I think the intense questions and worries about Fed independence kind of manifest themselves in the market. For now, those conversations I've had with clients and colleagues are still relatively muted.
Brian, is that because they're struggling to understand what 2026 actually looks like? My focus is going to shift there almost immediately. When we get the dot plot, of course, the immediate conversation is going to be, is it 2 rate cuts for 2025 or is it 3 rate cuts? And then all of a sudden it's 26. And the question I'm asking myself is the guidance from Chairman Powell about 2026 worth anything when in the next few months we're going to find out who the next Fed chair is actually going to be? So, Brian, I'd ask you the question. Are clients not talking about it because they just don't know what to do with 26?
Yeah, I think that's a great point, Jonathan. I think people are looking past Powell to an extent, but we don't know what that is yet. We may get some clarity in the coming weeks. There have been stories about the Treasury Secretary interviewing potential replacements. We may get an announcement on a nomination earlier than usual. Powell's on the job into May of 2026. Maybe we get a nomination announcement at the end of this year, early January. For now, I think we're in a holding pattern. Everybody trying to figure out, okay, who's after Jay Powell? What does that person look like? How independent can that person be from the administration? And, to Miran's comments at his Senate confirmation hearing, backing up Fed independence, reaffirming Fed independence, how much does the new chairman lean into that message of Fed independence and then act on it later? Because as we all know, rhetoric is one thing, but the markets are going to have to see action, by the new chairman when he or she takes office.
Brian, when you zoom out to try to understand the context that some of these Fed pressures are coming in and what the president's ultimate goal is, do you have a framework of understanding what the urgency was to get Lisa Cook off the Board of Governors before this meeting? Why that has been such a pressing concern and might even continue to be a fight ahead of tomorrow?
I think a lot of it is political leaning into 2026. Jonathan, just asking about, investors thinking about 2026. Well, let me offer a different context for that of 2026 is the midterm elections. I am surprised at the level of intensity that the White House is leaning into the 2026 midterm elections. Not that any administration takes them lightly, they don't, but between the redistricting battles that are going on in the states and trying to make sure that the economy is on track and strong going into the midterm elections, I think those kind of play hand in glove. So I think that is part of the calculus here.
Brian, it's such a good point and a good point to leave the conversation on. Thank you, sir. Brian Gardner there of Stifel on the politics at the moment. David Kelly of JP Morgan Asset Management writing this. To the extent that the Fed's decision this week is seen as a capitulation to political pressure, a new layer of risk is being added to U.S. financial markets and the dollar. Will it be seen as political capitulation?
That's the reason why people are watching the dollar. Ultimately, if the Fed has a dovish tilt, does that end up weakening the dollar further, even as it juices risk assets? I was looking at some studies put out there over the past couple of days from Deutsche Bank showing that the proportion of hedged equity exposure, hedged to the dollar, has become the greatest in decades. So this is where we're at right now.
Dollar weakness again this morning, euro dollar 118. Coming up next, Elias Galou of Bank of America Securities on record valuation fears on Wall Street. Plus, Danny has your morning movers. Oracle rising on the odds of a deal with TikTok. Their stock is up by 4.6%. From New York City, you're watching Bloomberg TV. Reclaiming record highs to start the trading week. Equity futures up again by 0.2% on the S&P. On the S&P 500, a fifth day of gains in 6. On the Nasdaq 100, 9 consecutive days of gains on the Nasdaq 100. The longest going back to November 2023. There's a lift to this equity market once again. In the bond market, 2-year, 10-year and 30-year bond yields pulled lower in yesterday's session, down again this morning by almost a basis point, 352.83. going into the Fed's two-day meeting. That starts later on this morning with some dollar pressure, dollar weakness. Check out euro dollar this morning, 118. 118. Haven't spent much time above 118 through 2025 so far. Haven't done that since the summer. This from Kit Jukes of SocGen this morning. I reckon the market is less long euros than I feared. The chances of a move to 120 this month have improved.
And frankly, that's been the trajectory so far. It's interesting that the shift toward betting on some sort of questions around Fed dominance have shifted away from betting against the long bond, which has been actually one of the biggest points of rallies, and actually shifted to more the dollar. And that has been where it has stayed. And this sort of is this bet that is consensus but keeps on climbing.
How long before ECB officials come out and just say, enough of that, less of that?
120.
Yeah.
That's what we heard, right? Didn't Centennial of Portugal
back in
say
the
that?
summer.
Yeah, exactly.
That was
what he said. Yeah, and then, here we are.
Back at those levels again. 118.14 on euro dollar this morning. 3 hours away from the opening bell. Let's get you some single names, some morning movers. Oracle in focus. Danny has more. Hey, Danny.
Yeah, another good day for Larry Ellison. At least that's how it's shaping up. Yesterday, Oracle got a boost over the news that an agreement was inching forward for TikTok between the U.S. and China. Of course, Oracle had been in that original group of bidders. There's a CBS News report overnight also saying that this time around, Oracle is active in the talks for some sort of deal that would help TikTok continue to operate in the U.S. It didn't talk about structure. That wasn't reported on, but still shares are up 4 1/3%. Elsewhere, New York Times falling this morning with Trump overnight posting on Truth Social that he would be seeking a $15 billion defamation suit against the paper, accusing them of being what he called a mouthpiece for the Democratic Party, citing their endorsement of Kamala Harris. That $15 billion defamation lawsuit, by the way, is more than their market cap is. So those shares falling 1%. Finally, a double upgrade by Goldman Sachs to the chocolate maker Hershey's. Those shares up 2.4%. The analysts over there citing a couple things. For one, saying higher prices, tariffs, those are all well understood and baked into the share price now. But they say they have iconic brands, so they have pricing power. Separately, an industry magazine said that Hershey's has started to raise prices for things like Kit Kats, Reese's Bars, Payday. So get ready to pay up for your chocolate. John.
Danny, appreciate the update. Danny, thank you. More from Danny in the next hour. What did you want to add on that story?
Chocolate.
Oh, yeah.
Sorry.
Got something to say about Hershey's chocolate?
I wonder how much they're just reducing the actual volume of cocoa.
Are you a 60 to 70% kind of person? We keep going back to this story, don't we?
I mean, have you met me? Of
if
course.
It's not 60, it's not real.
Yeah, totally. But also,
right.
You just don't want it to be like 2, and that's sort of what also has been happening. All right, this is not
That's
what
Hershey.
anyone needs
The
to
other
know
thing I
about.
wanted to say about Oracle is I feel like every day is a good day for Larry Ellison.
I was going to say the same thing. It's every day is a good day for Larry Ellison, and Hershey's doesn't have a lot of
He's on a boat somewhere and he's feeling good. I have no doubt about that every time I hear his name.
He probably is sailing because he's a sailing competitor,
Right.
or on one of his islands because he owns Hawaii, things like that.
Basically, Lanai, right?
Basically.
I think, yeah.
Looks beautiful.
Been there before. Beautiful
Have you?
island, yeah.
You were his personal guest?
I was not, no.
Please tell us
I was
more.
not. There are a couple of hotels there that the average person can frequent if they wish.
Yeah,
all
yeah,
right?
for
Okay.
a cost.
Good to know. Yeah, for a cost. It's another time for another story, all right? On our radar this morning, the Fed's dual drama. The Senate confirming President Donald Trump's economic advisor Stephen Miran to the FOMC. Meanwhile, Fed Governor Lisa Kirk will keep her post after a last-minute court decision. Elsewhere, US and Chinese officials reaching a deal to keep TikTok running in the United States. A framework suggesting the app will switch to US-controlled ownership. President Trump and China's Xi Jinping will confirm the deal on Friday. And finally, what a story in the last 24 hours. The SEC prioritizing a proposal from President Trump to reduce corporate earnings reports. Trump posting on Truth Social, companies should report on a 6-month basis to save money and emphasize long-term planning.
Yeah, and this is something he proposed the first time around when he was president back about 9 years ago. There's a real question here about whether the SEC will go through with this. Okay, I'm biased. Yesterday I came out, my knee-jerk reaction was to say this is bad. Less transparency is bad.
Okay.
I'm a journalist, want to dig through the details. I started looking, and actually in Europe, as you know, most companies are only required to report about 6 months, every 6 months. But most of them report every quarter because that is the investor demand. On the flip side, some companies say, look, the amount of energy and money we have to spend going into these reports is onerous, and we could invest in other technologies and more long-term goals. So I'm sensitive to that, but I'm also realistic to the idea that even if you remove that requirement, a lot of these companies will still do that, just like they do in Europe.
I'd be very interested to see who trades at a better premium, just from a valuation perspective, based on the amount of clarity and transparency they offer on a quarterly basis, or a 6-month basis? That would be my test for all of this.
I wonder if it's the banks more, just not because people think that they're hiding something, but because of how much more onerous it is for them to go through and report every single line item in a way that doesn't subject them to some sort of oversight. Adina Friedman of NASDAQ came out and actually wrote this post and she's talking about how important it is to reduce some of the regulatory requirements, given how much companies have moved to the private markets, right? How much is that the backdrop for some of this push?
You know what I'd like to see the banks do anyway, which is report after the close instead of doing that mental dump in the morning where all of them report at the same time.
Not biased, not self-serving in any way.
No one actually reads the earnings reports properly until later in the day.
No one reads until later in the day.
Well, I'm sat here, it's difficult to read all the earnings reports at any given time.
I understand. Do you want to talk about more? I know it's been difficult
I just prefer it when the tech earnings come out after the close. You have some time to get through things, you listen to the calls, everything's just a little bit more relaxed instead of the mad rush before the opening bell.
I think a lot of people are relating to you right now.
Hopefully it's not just me.
It's not just you,
Maybe it is just me.
No, I think it's the whole idea of into markets versus after markets.
Right.
And
yeah,
I don't think that's what the SEC is.
It might be just me, in which case, okay. Let's turn to markets. Valuation fears rising on Wall Street. Bank of America's Global Fund Manager Survey saying a record 58% see global equity markets as overvalued. Elias Galou, the senior investment strategist at Bank of America Securities, joins us now for more. Elias, what an interesting moment, and welcome to the programme. Picked out 2 bullet points from your survey this morning when it was released. We've got this equity allocation that's the highest in several months, and at the same time, you've got these valuation fears dominating too. Elias, how do you think we're going to reconcile those two things?
John, I think it's one of the great points from the Global Fund Manager Survey. On the one hand, investors see global stocks as the most overvalued on record, but that was already the case last month when you and I met. And at the same time, they increased their exposure to global equities to the highest since February. In fact, valuations is the one factor that matters most over the long term. But in the short term, investors focus on the cycle, and this is a cycle that's dominated by strong macro forces, which are huge monetary easing. There have been 95 rate cuts year to date, and from tomorrow, the most important central bank in the world will join the rate cutting party. And on the other hand, there is a micro force like no other. I'm talking, of course, about AI, and FMS investors are very bullish about AI. They think this is a deflationary force. They think this is a force that is already lifting productivity growth, and that is why they continue to buy the stock market and to buy the very expensive tech sector despite sky-high valuations.
Elias, they are bullish on AI, bullish on the equity market. How bullish are they on growth? I understand that everyone's long rate cuts at the moment, but is that leading to an improvement in the outlook?
Look, amongst the huge convictions from FMS investors, the one that the Fed will be cutting and global central banks will deliver further rate cuts is maybe the most conspicuous, right? We have a share that is greater than 80% of FMS investors who expect short-term rates to be lower. You mentioned the dichotomy between sky-high valuation on one hand and an increase in equity exposure. The other dichotomy in the FMS is the fact that everyone expects rate cuts. A net majority see at least 4 rate cuts from the Fed in the next 12 months. And on the other hand, investors are actually very highly concerned about inflation, and consequently, the expectations that bond yields will rise in the next 12 months is the highest since August 2022, when inflation was a few points higher. So I do believe that this view that the global economy is heading into a global soft landing is at the heart of global investors' stock optimism, but ultimately they think the global economy will weaken, but inflation as well is going to stay elevated. Altogether, the soft landing conviction is the one that explains why investors' optimism in terms of stock exposure is rising.
Elias, I want to stay on that for a minute. You said that the number one tail risk right now is inflation, exactly because of what you just put out there. We're seeing inflation above 2%. We're seeing inflation above 2.5%. What will it take for this to manifest itself in the psyches of investors?
Look, I do believe that the conviction that, yes, inflation is here to stay above target, but AI, which is, again, dominant micro force that is driving investors' bullishness, will be able to lift productivity growth over the long term, help profits growth and help margin, is what is also holding investors' optimism in an environment where inflation is above target. It's the fact that the hyperscalers are able to increase capex, right? In an environment where inflation is high, usually investors would be a little bit worried about corporates increasing capex at the extent hyperscaler are doing. And yet, in this survey, we find out that the CIOs, the typical fund managers participant, is asking CFOs to focus on capex more than anything else. The conviction that AI is the dominant macro force is why, at the end of the day, investors are bullish and they think inflation yes, it is a concern, but is not detrimental to stocks.
And it fits this puzzle, this idea of how you can have ongoing growth without commensurate inflation and maybe a pretty tepid rate of hiring. I am curious about your view on the dollar, because we've been talking a lot about the weakening trend that we've seen over the past number of months. You said that the fourth quarter pain trade seems to be a stronger dollar. Just how overweight are investors to this idea of a weakening dollar right now?
Look, if you look at the fund manager survey in itself, investors say they are underweight the dollar. We hit peak dollar bearishness in June. Since then, it's stabilized around that level. But when you look also at the hard positioning data, the flows data, to us, it feels that investors are emotionally bearish on the dollar rather than physically bearish. If you look at the flows data, the picture that we saw over the summer is quite mesmerizing because in fact, we didn't see any net new inflows to US equity funds, but at the same time, in August, we actually saw the biggest monthly inflow to US bond funds, driven by near record pace of inflows into US IG funds. So if investors were truly bearish, physically bearish on the dollar, they would not be buying US bonds at a record pace. So we think it's really a matter of hedging. Investors want to hedge against a weaker dollar, but they are not ready to sell the beloved US assets. And we think that US dollar bear market or the debasement of the US dollar is to us the cleanest investment theme into 2026. The price of gold, the price of cryptos signal that the dollar will weaken further.
Elias, before you go, just want to squeeze this in. You're sitting in London. The president's going to join you in the next 24 hours or so. He'll arrive in the UK as well. You've got these contrarian long trades in here, bonds being one, the other UK equities. Elias, why does that jump on the page to you?
Look, this is why I'm in London today, just to be an advocate of UK equities, and a very unloved asset. What struck me in the fund manager survey is that investors were already underweight UK stocks, but what happened in September is that they decreased their allocation to UK equities by the most since 2004. Matching the biggest drop on record. So if investors truly believe that the economy will be heading into a soft landing, that bond yields will remain anchor and we won't see a big breakout of global government bond yields, I think there is one asset that is very cheap, very much under-owned, and in which you can get a big bang for your buck. It's UK equities.
Interesting. The pessimism there. Just amazing. Elias, appreciate your time. Thank you, sir. Elias Galou there of Bank of America Securities on the latest fund manager survey. I love reading through this, just capturing, putting some numbers on where we've been. Investors cut EM and EU equity longs. They covered US shorts and added to longs in tech. Surprise, surprise. The biggest cut of large over small cap longs since December 23 speaks to the move we've seen in the Russell over the last month.
Yeah, the idea that people are betting on the cyclical part to really outperform. What I found interesting was Elias also went on to say that people keep piling into tech, even though they view it as the most overvalued sector, which sort of speaks to this AI bullishness. And the reason why people are saying, let's look at Asia, let's look at other places to get exposure to this story, because we believe in the story, but we're just a little worried about valuations.
The Nasdaq move continues this morning, up another 0.3%. With an update on stories worldwide, with the latest, here's your Bloomberg brief with Yahara. Hey, Yahara.
Hi, John. Secretary of State Marco Rubio is in Qatar today. It comes just a week after an Israeli missile strike on its capital targeted Hamas officials in a residential area. Earlier this week, Rubio met with Israel's Prime Minister Benjamin Netanyahu as Israel intensified strikes on Gaza City overnight. Rubio also warned Hamas there's a very short window for negotiations to end the war. Meanwhile, prosecutors in Utah are expected to file capital murder charges against Charlie Kirk's alleged assassin. 22-year-old Tyler Robinson will make his first court appearance today. Investigators have used DNA evidence to link Robinson to the murder, including a screwdriver recovered from the rooftop where the fatal shot was fired. And Alphabet's Google said it will invest $6.8 billion over 2 years in the UK to boost AI development. The tech giant disclosed the plan just as President Trump is set to head to London today. OpenAI and NVIDIA are expected to pledge investments in UK data centers worth billions of dollars during Trump's visit. That's your Bloomberg Brief. John?
Yahara, thank you. I've just got one question. Where's the energy coming from? We could spend some time on that story in about 45 minutes' time. I think you've got more to say on Hershey's. Is that right?
Well, okay, so some people were saying, why do you hate Hershey's so much?
Sure.
The amount of cocoa content is 11%, just above the 10% legally required to be considered chocolate in their average.
That's the threshold.
Hershey
I didn't know that.
I didn't know that either.
Okay.
So 10%. So once you get to 9%, what do you call it?
Barely chocolate is basically what you're calling it
Mocha
right now.
infused.
Almost chocolate. Something like that.
I'm just saying, I like actual chocolate.
There you go. Okay, you done now?
I hope so.
All right, good. Okay. Up next on the program, making a deal for TikTok.
You had the framework that's been agreed to with TikTok. Will China continue to have a stake in the company?
Well, we haven't decided that, but it looks to me, and I'm speaking to President Xi on Friday for confirmation of that. It's important, and it can maybe even bring us closer to China.
That conversation up next with Angelo Zeno of CFRA from New York City. You're watching Bloomberg TV. Record highs coming into Tuesday. Equities up again by 0.2% on the S&P 500, up by a third on the Nasdaq. The run on the Nasdaq continues. 9 days could become day 10. Under surveillance this morning, making a deal for TikTok.
You had the framework that's been agreed to with TikTok. Will China continue to have a stake in the company?
Well, we haven't decided that, but it looks to me, and I'm speaking to President Xi on Friday for confirmation of that, and, you know, frankly, more importantly, a big deal. It's important, and it can maybe even bring us closer to China. I was surprised. I didn't expect it to that extent.
So here's the latest this morning. US and Chinese officials agreeing on a framework to keep TikTok running in the United States. Angelo Zeno, senior equity analyst at CFRA, speculating Larry Ellison and Oracle are likely to be involved in the new agreement. Oracle hosts TikTok user data, and Trump has voiced support of Ellison in the past. Angelo joins us now for more. Angelo, welcome back. It's almost 5 years to the day, I think, that we were talking about a tie-up between Oracle and Walmart to address this issue, and here we are 5 years later, still trying to work it out. We're going to go into the realm of speculation, so forgive me. What do you think the ultimate end game is going to look like for this company?
Yeah, so thanks for having me, John. I think the ultimate end game here is a situation where and we still obviously don't know here, but you're going to have basically an algorithm that's going to have to get sold to set off to a U.S. company. There's going to be basically a duplicated recommendation algorithm that kind of gets powers a new, let's call it, app out there, and it's going to be owned, we think, by Oracle and a consortium of investors out there. And when you kind of think about all this, it's a tough situation because exactly how this all looks remains to be seen. But our view is it's one where just given the conversations we've seen and where Oracle kind of sits here in terms of hosting the data and what have you, they really do have to play a role in all this. And that's how we're kind of looking at it right now. But, there's still clearly a ton of moving parts and unknowns with all this.
Does TikTok remain in the same position, or is there some sort of change in the competitive landscape for social media on the back heels of this?
Yeah, I mean, and that's a great question. So we do think, when you kind of look at the market reaction yesterday, right? I mean, most of these stocks actually within the social media space actually rose, and not surprised by that. I mean, I think for the most part, the overall, I think the market's already priced in the fact that, hey, listen, TikTok was going to remain here in the U.S. I think, ultimately what you see here, if it is owned by, Oracle and a consortium of investors out there is, I think near term, I think it becomes a little bit of a mess in the sense of execution. You're going to have to see essentially all the 170 million plus users out there kind of roll into potentially a new app. You're also going to have to see this new kind of entity operate without, likely the help of ByteDance and, their expertise on that side of things and what they've accomplished here over the last several years with TikTok. So in some sense, whoever's acquiring these TikTok assets benefits from the potential monetization that TikTok offers here on the ad spending side of things. Clearly engagement is extremely high. Who they cater to in terms of the younger audience, very attractive in nature. But when you start thinking about, execution, some of the hiccups that we could see along the lines here from a new entity, we do think 1, 3, 5 years down the road, there's a lot of uncertainties and potential messiness. And because of that, I think that was a big reason also why, the Metas, Alphabets of the world also saw a positive reaction on the news yesterday.
And this might be too much of a reach to ask, Angelo, but do you have a sense of what any kind of TikTok deal could mean for U.S. tech companies in China, their presence there, whether there's any crossover?
I think when you kind of look at some of the noise that had come out over the weekend as well in terms of, some of the back and forth with, both what U.S. had implemented as well as what some of the greater kind of scrutiny that we saw from China themselves. I think they're clearly both trying to put themselves in pole position in terms of the greater dialogue here. I think what China really wants on the technology side of things is really greater access to potentially NVIDIA's more advanced chips, likely Blackwell, as well as high bandwidth memory, which is something, they don't have access to at this point in time either. So that's really what we think kind of China wants from the U.S. in terms of this back and forth dialogue here over the next couple of weeks and months. We'll see whether or not and to what extent they get some of that. But that's where I would think kind of the focus for China is at the moment.
Angelo, final question. You said Oracle and a group of investors. You didn't say the White House. Does the U.S. government get a piece of this?
Yeah, I would suspect that they would. At this point in time, right, you look over the last couple of weeks and months, it seems like the U.S. is playing a bigger role in all this in terms of taking a piece of, some of the assets in some of these, companies. So, yeah, I would suspect that the U.S. government probably wants a piece of this, and I would suspect that they do get it.
Interesting. Angelo Zeno of CFRA. Angelo, thank you, sir. That raises a lot of questions about a competitive landscape for other companies. Remember Meta and Mark Zuckerberg's seat at the table next to the president in that recent dinner? Just how favourable their treatment might actually be if the government's got a stake in their main competitor.
It raises a lot of questions. What does that stake look like? This already has been raised with social media companies owned by members of the administration themselves. So just the questions will continue.
A lot of questions on this one. Up next on the programme, Paul Quincy of JP Morgan, Monica Guerra of Morgan Stanley, the former White House trade advisor Kellyanne Shaw, and Ian Lingen of BMO, the second hour of Bloomberg Surveillance. Up next.
I'm not fleeing U.S. equities at all.
The stock market just wants to look past the weakness in the data.
It's a more uncertain environment than what we would prefer.
I would just from a fundamental perspective still prefer the US over Europe.
The market's going to trade off the narrative that we have a dovish Fed.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. A 9-day run of gains on the Nasdaq 100. That run continues this morning, up by a third of 1%. All-time highs. Record highs on the S&P, up another 0.2%. In yesterday's session, to start the trading week, bond yields pulled lower. Down again this morning at the front end of the curve. Your 2-year bond yield down a basis point, 352.62. Going into this data right here, it's about 90 minutes away. Retail sales in focus before the Fed meeting begins.
This to me is really a question, not only whether consumers have kept spending in the face of a lot of uncertainty and bad feelings that they represent in certain surveys out of these places in the Midwest, but also how the market responds to that, right? If people are just ratcheting back spending a little bit, does the market treat that as a good thing because that means that the Fed can keep cutting rates and that can really foster this optimism that we're seeing in equities? Or are people starting to get seriously worried about a turn in this cycle? Right now, weak data has translated into Fed cuts. It has not translated into expectations for a softer economic trajectory.
This has been a theme on this program through August into September. This market appears to be overweighting the rate cuts and underweighting the reasons for them. Does bad news ultimately become bad news? Is that story reverse?
Yeah, and how much of this really hinges on the story that AI is going to magically improve growth, improve productivity without causing some sort of inflationary spiral that leaves consumers feeling even worse when they go to the store and have to buy eggs and Hershey's chocolate? This, to me, is a real question going forward. And ultimately, people are banking on AI all in, hyper-leveraging it to it in every facet of the economy, and we're all along for the ride.
Record highs again this morning. Just how hot is the Federal Reserve willing to run this market? Pretty hot right now based on the forecast we're looking for from the Federal Reserve tomorrow afternoon. Equity futures on the S&P 500 positive here by 0.2%, a lift again to stocks this morning. Coming up this hour, we'll catch up with Paul Quincy of JP Morgan, with stocks delivering another record high. Monica Guerra of Morgan Stanley, with a new Fed governor joining the board, and another keeping her seat. Plus, the former White House trade advisor Kellyanne Shaw, as trade talks lead to a Trump Xi call. We begin this hour with stocks hitting another all-time high as investors eye a Fed rate cut. Paul Quincy of JP Morgan writing, markets have recovered to new record highs. If policy risks come back into focus, equity valuations are now elevated and markets will struggle. Paul joins us now for more. Paul, good morning.
Good morning.
It's good to see you. Let's just go through where things are at right now. Earnings good, jobs data not good. Is one much more important than the other?
Yes. It's always about the earnings. And that's how we got here, right? I remember being back on Bloomberg in the middle of April. We were about 1,200 S&P points below where we are now. The market was moving 5% a day. It felt like a crazy time. In the end, yet again, the optimists have triumphed, right? And the reason the optimists have triumphed is earnings. So we just had, of course, second quarter earnings. We're done with that now. They were terrific. Of course, AI was the shining star, but really across the market, there were plenty of companies who are beating expectations, and it's really that's been underwriting this, this incredible recovery that we've seen.
To your point, Paul, earnings have stepped up, but payrolls growth has stepped down. Are there limits to how far that story could diverge?
Look, the big driver of earnings, we have to be realistic, is the AI investment boom, right? That is what's got everyone's attention. And whilst the earnings are good overall, that has been the kind of central piece. That's been the biggest driving force in the second quarter earnings. And this year, so the famous Magnificent Seven are going to do mid-20s earnings growth. Everything else, we're still waiting a little bit for that broadening out of profits to come. We think it will come. We think it comes into next year. We think next year, by the way, is better for earnings overall than this year, as we see it right now. And we think the gap between the 493 and the 7 probably narrows as we get into next year. But without question, the best part of it is coming from those mega cap tech stocks.
You have seen, though, this broadening out to that point, and you see that continuing early next year. What makes you confident about that, given that there have been a number of studies, say from MIT, that have pointed to a lack of monetization by some of the smaller companies that have been spending quite a bit on this new technology?
Yeah, look, it's early days, right? I think we have to be humble about AI and recognize there's still a tremendous amount we don't know. We lean optimistic. We think these big investments that are being made, these gargantuan investments, are going to have a positive impact. And they're big enough that they're impacting a whole bunch of companies outside the usual suspects. So you think about the whole value creation chain, right? From the electricity generation and transmission, the data center construction, the cooling, the memory, all the things that go into that. And then, of course, the downstream adoption, too. So I think you're going to see plenty of positive news coming from all of that. And that alone is going to be enough to help the market broaden out.
How much does this market need the rate cuts that a lot of people have priced in order to keep going? How much do we need to see 150 basis point of rate cuts or more by the end of next year?
So look, risk reward, again, I keep thinking back to April. Risk reward looks very different now, right? It's great. Stocks have gone up, but we're now 24 times forward earnings for the S&P. That's one of the highest numbers we've seen. And within the market, you've got the memes and themes running hard. People are feeling pretty good about life, right? So I think it's really important to stay active, recognize the opportunity set changes, and also think about where returns can come from in the rest of the world too. So we've been spending a lot of time talking to clients recently about emerging markets. A New York private banker said to me last week that his clients had somewhere between nothing and 0% allocated to emerging markets. And if you think about the last 5 years, that's not been wrong. You've had around, 6-7% returns. That's less than half what you got from the S&P. But on a forward-looking basis, we think that's going to be much different, and that's really starting to change as we go through this year, too.
Well, tell us why you think that might change. What's behind that?
So we put out something about 3 months ago, 5 reasons to like emerging markets, right? Number one, where it seemed to be, we're not really macro people in equities, but we're in a weaker dollar environment. That's usually positive. Secondly, the hit from tariffs, we think, is a little bit overstated. So, for example, in China, 80% of the revenues of the companies in the Chinese stock market come from China. In India, it's pretty close. So that's number two. Number three, China seems to be through the worst. Things are not great, but at the margin, they're getting better. 4, India's growing strongly. And 5, probably the best one for us as stock pickers. Don't forget, there's a ton of technology stocks in emerging markets, too. So about 20% of the earnings from the emerging market index come from technology. And you can buy those companies at much, much lower ratings than you pay in the US. And they're joining in this AI boom too.
Am I just buying Chinese tech? Isn't that just a different wrapper for the same thing?
There's a lot more in emerging markets than that. There's 28 different countries. There's over 1,000 companies. There's a lot more you can invest in than Chinese tech, although we'll find some opportunities there as well.
And Bank of America was talking about investing in Chinese tech as well and other emerging markets. But isn't that out of the fire into the frying pan, or out of the frying pan into the fire? I get every single expression wrong. Going forward, just because ultimately, if you're worried about policy uncertainty, well, isn't that the epicenter of it?
Again, it's risk reward, right? So the emerging market index trades at about 13 times forward earnings. That gives you a little bit more of a cushion there should things not work out quite as well as everybody expects. We're coming out of one of the longest periods we can remember in which clients have had no interest in emerging markets at all. Allocations, as I said, pretty low. So I think all of those factors give you some comfort. If you're worried about the enthusiasm towards US stocks, the high valuation that you have to pay in the US these days, even though most of that we think is justified, then I think adding a bit of emerging markets in your portfolio is going to help you in the next 5 years, whereas it really held you back in the last 5.
Speaking of emerging markets and growth stocks, European bank stocks, and I don't mean to say that is an emerging markets because I will get a lot of hate mail, but there is this sense that they've come pretty far. It's been tripling in the past 4 years, I believe, and you've seen an incredible surge in valuations across the board. Is that overdone, this optimism in the European region, in particular, hinged by their banking sector?
It's a great question. Our European investors love to show me the chart that illustrates European bank performance versus Magnificent Seven. European banks have considerably outperformed. It's not even close, actually, in the last 5 years. Look, from here, those returns are going to come down, that's for sure. But you have to consider the starting point. European banks were priced as if they were going to destroy value forever. It took 15 years to get past the financial crisis. So they've moved from extremely cheap to sort of reasonably priced, and with still pretty good momentum. Now, there are some risks, right? The more money European banks make, the more likely they're to attract regulation and taxes, the more likely they are to sort of think about M&A, which is more questionable, rather than returning money to shareholders, which has been terrific. Dividends and buybacks and a big part of the story. So it's a bit more balanced. But I still think there's money to be made. And I think the broader point, again, is there are 2,500 companies in the world that you can invest in large cap, right? So just looking at 7 of them is not the right way to run a global portfolio. It may not be European banks, but there are going to be other opportunities that are going to put their head up and are going to make you money as an investor.
Paul, you spend a lot of time going through these companies. What would it mean to you if we backed away from quarterly earnings reports here in America?
Look, we've always thought long-term earnings are what matters. Long-term thinking is the right way to run a company. We think the companies we admire most are run for the long term. And when we look at companies, we think about the earnings that they're going to generate over the next 5 years. That's really where our focus is. So long-term thinking, we think, is just a really good thing.
Do you see any evidence at all that because of quarterly earnings and the shift to that over the last several decades, that the mentality of corporate America has shifted to a more short-term view?
Look, I think if you look at, for example, the massive investments that are being made by the big 5 in data centers, those are not being made to make money next quarter. So I think sometimes, people worry a little bit too much about that.
That's a pretty valid point, given how many hundreds of billions of dollars have been announced in capex from just a handful of names.
Exactly. $350 billion roughly this year, up from 200 something last year, well over 400 next year. That's a long-term investment in the future of AI.
And the Bank of America Fund Manager Survey said that investors were rewarding companies for spending their cash on capex, not necessarily investing just in buybacks and dividends. So it seems like people do have a long-term mindset. At the same time, maybe they can do that because they're still generating a lot of cash.
Paul, if we did go to a 6-month basis, do you think companies that stuck with a quarterly earnings kind of cadence, do you think they'd be rewarded?
It's really hard to know, right? That would be a very hard thing to judge right now. Again, I think as long as companies run for the long term, and the best ones should be and are, and investors take a long-term view, that's the way to make money in the stock market.
Paul, appreciate your time. It's good to see you. I think we managed to get through basically all of that conversation with about that much on the Federal Reserve, because that's how important that is to some people at the moment.
Well, it might be important, but what else can you say? I mean, honestly, there's a certain level where either they're going to be dovish or they're not. They're going to be politically influenced. We're not going to necessarily know to what degree. There are all these questions that aren't going to get answered tomorrow, even though we want answers. So we can keep talking about it, and we will. We'll even have a special on it.
We are going to have a special. 2 specials, in fact. One on the trading floor over at Bank of America tomorrow morning, then another special around this desk tomorrow afternoon.
And we'll just focus on the Fed.
And you'll be even more frustrated tomorrow when you don't get the answers you want tomorrow afternoon. So look out for that too.
I'll come up with new frustrations.
Special thanks again to Paul Quincy of JP Morgan. Paul, thank you.
Thank you.
It's good to see you, sir. Thank you very much. Futures up by 0.2% on the S&P 500. All-time highs on the benchmark in America coming into Tuesday. With an update on stories elsewhere. With your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. U.S. officials are in India for trade discussions, signaling that the two nations may be moving closer to resolving their differences. The negotiations come weeks after President Trump doubled tariffs on India to 50%, citing New Delhi's trade barriers and purchases of Russian oil. Trump earlier said he will speak with Indian Prime Minister Narendra Modi in the coming weeks. And you all were just discussing this with Paul. Wall Street's main regulator says it's prioritizing President Trump's call to reduce the frequency of corporate earnings reports. The SEC says it's pursuing a proposal to further eliminate unnecessary regulatory burdens on companies. The agency has mandated firms to report quarterly since 1970 after a decades-long push to increase transparency following the 1929 market crash. And President Trump is expanding the federal government's crime crackdown. Trump approved the deployment of the National Guard in Memphis. The FBI, the DEA, and other agencies will also be sent to the Democrat-led city. The president says he plans to send forces to Chicago next and is also looking at St. Louis and New Orleans. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira later this hour in about 30 minutes' time. Up next, the Fed's new governor.
I will act independently, as the Federal Reserve always does, based on my own personal analysis of economic data. I plan to dutifully carry out my role pursuant to the mandates assigned by Congress. Independence of monetary policy is a critical element for its success.
That conversation up next with Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning. The main focus this morning, big data point, US retail sales. Consumers don't feel great right now. We can see that. We can see why. In the labour reports we've had over the last 2 months, how are they spending? Has that changed? That's the story for 8:30 Eastern Time. Equities into that, up again by 0.1% on the S&P. Big tech keeps doing what big tech has been doing for a long, long time. The Nasdaq 100 on a 9-day winning streak, up again this morning by 0.25%. Under surveillance this morning, the Fed's new governor.
I will act independently, as the Federal Reserve always does, based on my own personal analysis of economic data. I plan to dutifully carry out my role pursuant to the mandates assigned by Congress. Independence of monetary policy is a critical element for its success. The Bureau of Labor Statistics data on various measures has deteriorated steadily in quality over time. I do think it is time for a fulsome examination of the process, of the regulatory process, to sort of think about where we want it to be going forward.
So here's the latest this morning. The Senate confirming Stephen Miran as Federal Reserve Governor just in time for the FOMC meeting starting later on today. Joining us now with the latest, here's Tyler Kendall. Tyler, this has been a big focus for a lot of people for a long time. Just who is going to be around the table for that meeting on September 17th?
Right, exactly, John. And we finally seem to have a little bit of clarity here as this nomination for Stephen Miran was confirmed pretty swiftly on a mostly party line vote. And we know that that was partly due to some strategic reasons. A person familiar telling us here at Bloomberg News that the administration chose Miran in part because he'd already been through the Senate confirmation process for his role heading the White House Council of Economic Advisors. That's a really critical part in this because Miran has said that he's going to retain that position. He's going to take an unpaid leave of absence because this is just a temporary role. He did tell senators, though, during his confirmation process that he would consider resigning it altogether if he were appointed to a longer-term position. President Trump does have that opportunity come February. He could appoint Miran to a 14-year term, or he could actually keep him on indefinitely in an acting capacity while he waits to fill that open position. Miran, of course, had served under the first Trump administration for the Treasury Department before entering the private sector and then coming back to help really helm President Trump's economic agenda and being perhaps one of the most robust defenders of his tariff policy. On the other side of this, though, is that we've learned who else is going to be at the table, and that's that it appears that Fed Governor Lisa Cook will be there as well after an appeals court based here in D.C. handed her a legal win last night, actually just 5 minutes between that legal decision and Stephen Miran being confirmed by the Senate. This appeals court says that President Trump very likely violated Lisa Cook's rights to due process when he fired her via a post on social media. But, John, at this point, the administration still has time to appeal to the Supreme Court, but we'll have to see if that actually impacts whether or not she's there for the meeting.
They're going to keep on pushing, that's for sure, based on recent comments. Tyler, thank you. Tyler Kendall in Washington, D.C. With us here in New York is Monica Guerra of Morgan Stanley. Monica, good morning.
Good morning.
So Stephen Miran becomes Governor Miran, and he's at the Federal Reserve whilst taking a leave of absence from the White House. Is that a conflict of interest or just a procedural issue? The Senate only has so much time to have confirmation hearings for Stephen Miran.
I think it depends on how far he goes in a potential dissent, right? Is when we're thinking about, is he truly a messenger for the White House, or is he taking a more measured approach? It's going to be a question for a while until, we actually have a couple of rounds, right, of voting on the records.
There's also a question of how much this really changes the Fed's commitment to fighting inflation. It seems like a lot of people are saying in markets, we need to wait and see just how much any kind of independence is compromised when we see how this Federal Reserve responds to inflation coming in hotter than expected, should that happen down the road. How much do you really look at that as the big sort of rubric for how we can understand Fed independence?
For us, when we're thinking about the data-driven Fed, they're going to continue to prioritize that for as long as they can, right? This is something that I think is important to all the chairs, the governors and participants on the board. So for me, again, the data piece is critical. Now, what we're watching really closely is what happens in the room today. If we see Miran go deeper than a 50 basis point dissent, for example, does that result in market volatility, right? Does it signal something that maybe the other, participants haven't, captured when we're thinking about potential data weakness, right? And inflationary factors. Does it push the needle for the next meeting, right? And essentially create a leading factor for our expectations.
And it goes to this sort of existential question right now, which is, are we seeing temporary weakness that can be sort of fettered away by rate cuts and by the change in the cycle and some of the one big beautiful bill and some of the benefits that a couple of companies and consumers get in the start of the year? Or is this actual weakness that is going to be pervasive?
Right, and we're just starting to see, right, what it's going to shape up to become. I think what's important and what the Fed is trying to balance, if you're thinking about cuts versus hikes, if you cut too quickly, right, too soon, that can also be inflationary. So if they're part of their mandate or part of their job, right, is to keep inflation under control, right, around at one point, right, that 2% rate that they were targeting. This is going to be a critical factor in their consideration. Now, do you get a deeper dissent from Miran? That's one question, and then do you have other joiners, right? If you're thinking about additional dissents in that equation, and does it signal more dovish activity from the Fed in the future?
The president, as you know, has been pretty transparent about why he wants to lower interest rates at the Federal Reserve. He wants to lower mortgage costs. He also wants to lower borrowing costs for the government. He's getting them. Yields are lower. Bonds have really performed quite well. From your standpoint, what's driving that move at the moment to fixed income? Is it a fact of the news being bad and ultimately that's good news for bonds, or is something else happening here?
Yeah, I mean, I've definitely keyed in on that bad news is good news narrative. And one of the things that I think exemplifies that, I'm going to change gears here a little bit to tariffs, is that initially, right, when tariffs were introduced, it was, a huge uproar within the markets, right? You had even bond markets misbehaving. And now with this revenue narrative that they're essentially pointing out, hitting home, reinforcing that's coming in from these tariff levels, if you lose that, right? So while that's good for the business and consumer side of the economy, meaning that lower tariffs makes prices come down potentially, that could create more stress on the fiscal policy side, right? For them to actually pay and support debt and deficit.
Do you think it makes it harder for the courts to strike this down, given how dependent the government is becoming on them?
I don't think that's going to be a key factor. I think they're going to be, doing their jobs, right, as far as looking at the actual legality of IEEPA and the way that it was implemented. Now, do I think that there are other ways to get there? Absolutely. So for us, when we think about, the bad news is good news piece, it's if you get a continued signaling that despite Supreme Court activity, Trump is committed, then markets are likely to continue to stay stable, less volatile.
I just wonder how solid this bond rally is. If we do get a government shutdown, say in 2 weeks, do you still get a rally into bonds, or do you get it bonds selling off based on some of the policy uncertainty that has been building up over the past couple of years?
Well, what's interesting about government shutdowns is that if they are occurring in isolation, right? If it's the main news of the day, right? Of course, they're never in isolation, but the main news of the day, you actually have positive market performance, right? Investors look through that time period because typically they last maybe 5 days. The longest we've ever had in history is 35 days, which then calls certain things into question because then government contractors aren't getting paid, salaries are not being allocated, and people may not be able to make their rent payment. And so once you get past that 30-day mark, that's when things get bumpy. But for us right now, we don't think it'll extend that long, because if you do have a shutdown, it then sort of gives the president the ability to cut budgets, which the Democrats do not want.
How many times have we seen this movie? Ends the same way, and markets don't seem to care.
Yeah.
See that on repeat, don't we?
I was wondering whether people cared more now just because there was a certain level of policy uncertainty, but evidently the answer is no. No, they don't.
At least not for the moment. Equity futures this morning, positive by 0.2%. A special thanks to Monica Guerra of Morgan Stanley. Monica, thank you. We are about an hour away from US retail sales in America, the last significant data point going into the Federal Reserve's two-day meeting. At least this time we know who's going to be sitting around that table, because there were some doubts over the past few weeks. And there could still be doubts if there is some sort of emergency appeal on the part of the Trump administration against the recent court ruling on Lisa Cook. Now my question is, how are they going to signal what is going to be the path going forward on the retail sales point, which we are about an hour away? I want to just say I'm watching the breakdown. How much of all spending keeps on getting driven by wealthy consumers and not by the lower tier or the lower two-thirds? And how do Fed officials count that? I don't know. What happens when you cut interest rates? Who does it help? Exactly. And who does it hurt? Yeah, exactly. Especially if it's long-term versus short-term. These are real questions that we want to answer. Important questions too. Futures up this morning then by 0.1%. Up next, we'll catch up with the former White House trade advisor Kellyanne Shaw ahead of President Trump's expected call with China's Xi. Plus, Danny has your morning movers, the latest in the $3 trillion club. The winning run continues on the Nasdaq again this morning, higher by 0.24% on the Nasdaq 100, on the S&P 500, adding a little bit more weight to the rally, up by 0.16. With your morning movers, with your single names, here's Danny Berger. Hey, Danny. Hey, here's a big add to the Nasdaq. It is Alphabet, which became a member of the $3 trillion club yesterday. There are now 4 companies worth that much. It gains about 1% this morning, this most recent leg of the rally, off the back of that positive court ruling where they avoided the most punitive measures in an antitrust ruling. They also had a city upgrade yesterday. And Lisa, you mentioned that Bank of America survey that investors are rewarding CapEx spending. Even more for Alphabet. They're planning to spend about £5 billion in the UK on AI data centers. That coincides with President Trump's visit.
Elsewhere, Chipotle shares are moving higher this morning, too. A little bit of a boost thanks to an announced buyback after the close yesterday in a filing saying that they've authorized another $500 million worth of share buybacks. That adds to a total of 750 million shares. It's something that Chipotle likely needs, considering those shares have fallen 33% year to date. Wrapping things up with a little bit of sell-side action, TD Cowen downgrading Warner Brothers Discovery, pointing out that those recent reports of Paramount Skydance buying Warner Brothers Discovery, saying that it's just speculation, this most recent rally. And the rally's taken it above their price target of $14. That's what's behind the downgrade, because there's been no movement yet on that bid, so shares falling just over 1.8%, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. One more single name for you, Tesla. Just about holding on to gains in the pre-market. Breaking news just moments ago. Facing a probe by the National Highway Traffic Safety Administration over door handles in some of its Model Y cars. Joining us now is Bloomberg's Craig Trudell. Craig, this is something the team have been writing about. In fact, they wrote a big story on it just last week. What's been going on?
Yeah, I definitely would recommend viewers go back and read Dana Hull's big take from last week, along with Emily Chang and Kara Carlson. They looked at Tesla's doors and the fact that they are powered electrically, and when your Tesla loses power, your doors no longer work the way they do normally. Importantly, what NHTSA is looking at here is particularly from the outside of vehicles. Tesla, in its own documents that it gives to first responders, to fire departments, police, they acknowledge that their vehicles cannot be opened from the outside when their cars have lost power. And this is the subject of this investigation. Importantly, though, I should note, they say that while this investigation is focused on operability of the door locks from the outside, as that is the circumstance that is the only one in which there is no manual way to open the door, they do say that they will continue to monitor reports of entrapment involving opening their doors also from the inside of their vehicles. So they leave out the possibility that this may be an investigation that is actually broadened beyond just a single model year of vehicles and about 174,000 vehicles, at least for the moment.
Craig, is this another example of a souring relationship between this company and the government?
I don't think necessarily. I think this is the National Highway Traffic Safety Administration doing its job, keeping an eye on where consumers are sort of, faulting the companies, the manufacturers whose products they buy for malfunctioning. Sometimes they investigate and decide to take no action. Other times they investigate and it leads to recalls. I think the important thing here for Tesla investors is that these are potentially issues that would have to be fixed beyond just, an over-the-air update. If Tesla ends up, coming to the conclusion that it needs to recall its cars in order to satisfy NHTSA, this could potentially be a costly endeavor for them to have to call these cars back and do some sort of hardware fix to make their vehicles more safe.
Craig, I know you're busy following up on the story, so thanks for making some time for us this morning. We appreciate it. The stock is still higher in the pre-market by 1.33%. As Craig pointed out, the team wrote extensively about this just last week. If you want to check it out, Tesla's Dangerous Doors by the team, the big take of about a week ago. Let's turn to some of our top stories on our radar this morning. The Senate confirming President Trump's pick for Federal Reserve Governor Stephen Miran ahead of today's FOMC meeting. An appeals court also rejecting Trump's efforts to remove Lisa Cook from the board. Elsewhere, the former St. Louis Fed President Jim Bullard joining the short list of names to replace Fed Chair Jay Powell. Treasury Secretary Scott Bessent confirming Bullard, interviewed for the job just last week, will be speaking with him exclusively on Friday. Look out for that conversation with Jim in a few days' time. And finally, Google announcing a nearly $7 billion investment in the UK. Artificial intelligence. It's the first of several US investments being unveiled ahead of President Trump's state visit over the next few days.
Maybe it's the consolation prize for still having to pay 15% in terms of tariffs. What's interesting, it's not just Google, it's also NVIDIA. Jensen Huang is there, as well as OpenAI, Sam Altman, and this is talking about some sort of increased boost in the United Kingdom. A lot of questions still remain about some of their engagement, given the fact that there are some questions around online rules, as well as just the ongoing questions around national security and beyond. Nonetheless, this is definitely something that Keir Starmer could use right now.
The UK has some of the highest energy prices in the G7. Some of the highest, the very highest. It's incredibly expensive already for consumers in that country. How are they going to power this? Where does the energy come from?
Interesting that you say that. They also have some agreements on nuclear nuclear power plants, and they want to kind of ratify one another's attempts to safely produce nuclear energy exactly in response to this. Sounds good. Problem is, it takes about 10 years to get those nuclear reactors up and running. So in the meantime, you have that short-term cost of living concern that continues to be a preeminent concern in the United Kingdom.
The government's got a lot of work to do on the energy front, that's for sure, and that's going to be a big topic of conversation as those deals are officially unveiled over the next few days. That's the latest on that. Anne-Marie's going to be on the ground in London. We'll catch up with her in a few days' time. Let's turn to trade. President Trump and Xi holding a call on Friday after trade talks concluded in Madrid, Spain. Joining us now to discuss is the former senior White House trade advisor, Kellyanne Shaw. Kellyanne, welcome back to the programme. So we get the phone call on Friday between Trump and Xi. What are you expecting to be the outcome of that?
Good morning. Thanks so much for having me back on. Well, I think what this is a pretty significant political and commercial deal. Now, we don't exactly know the terms. All we know is that this involves U.S.-controlled ownership. President Trump teased with reporters yesterday that there may be some government ownership, either U.S. or Chinese, potentially involved in this as well. So we could see some unique deals, kind of like what we've seen over the last few weeks with the Trump administration in exploring U.S. ownership and types of investment credits. But we'll have to see what this ultimately results in. The readout was pretty good. I'm expecting this to move forward.
Kellyanne, what is the larger significance of this, given the fact that expectations were pretty high heading into this meeting, that it wasn't just about TikTok, but the broader dispute between the U.S. and China?
Yeah, I think that's a great question. And we certainly had a deadline coming up this week in terms of ByteDance's need to divest in order to prevent the app from being banned in the United States. That's why the focus of this meeting was really on TikTok. But they met for 2 days. Clearly, they talked about a host of other issues. So the question is, well, what about the other $650 billion worth of bilateral investment and trade and economic relations between the United States and China? Where do we go from here? And we don't know much. So far, the talks have been relatively narrow in scope. They focused on export controls on the Chinese side for rare earth magnets. They focused on some U.S. export controls. Potentially, we could see some purchases announced as part of a leader-level summit that could come as soon as the APEC summit in October. But beyond that, I think there's a lot of work left to do in this relationship, and I don't expect some grand phase 2 style deal to emerge anytime soon.
So then, is it surprising to you that it's going to be capped off on Friday with a phone call between Xi Jinping and Donald Trump, given the narrow scope of what people are expecting?
Yeah, well, again, this is a very significant issue for the president. He ran on keeping TikTok alive, notwithstanding a congressional ban. This is a chit that China has been able to hold. It's a piece of leverage that they're now giving away. So I think this is a sign that they are saying, okay, we are gearing up for some leader-level summit that might have some big purchasing commitments. Maybe they'll talk about fentanyl and some sort of off-ramp there with steps taken from China for confidence building. But again, I don't know that China is also interested in a broad-based phase 2 agreement either. I think China's looking to stabilize the relationship, and this goes towards that, but it doesn't fix all the things that are wrong in the U.S.-China relationship.
Kellyanne, something I was wrong about. I thought we'd move pretty quickly back to the purchase agreement secured in the president's first term. What's the hold-up on that?
Well, I think a lot of water has run under the bridge between Trump 1 and Trump 2. You had the Biden administration who really didn't enforce any of these commitments. And now from China's perspective, this is something that they can give away. This is a piece of leverage. It's that commitments they've already made. They already committed to ag purchases, energy purchases, aircraft purchases, but they haven't really followed through with that. So again, I'm expecting to see them commit to at least that, if not more, in the coming weeks and months. But we'll really have to see what else happens here. Again, the world has changed significantly in the last 5 or 6 years. I just think that the chessboard looks different.
Well, let's talk about the rest of the chessboard. USMCA's got to be renegotiated. The Mexicans seem willing to put the walls up to the Chinese, something we know is going to annoy Beijing. I just wonder how the US and China are going to figure that out in the next year. And I just wonder if that's a recipe already for tension further down the road.
Yeah, and this was really interesting. And I would actually rewind back just a few days to Friday, where the Department of Commerce put 23 Chinese entities on its entity list. China, of course, retaliated with launching its own investigations of anti-discrimination, anti-dumping, and then its finding in the NVIDIA case. But what we have here is a relationship where China and the U.S. can still make progress on politically significant issues like TikTok, while at the same time defending their own interests on other areas of the economic and national security chessboard. So when it comes to Mexico and those tariffs that are now going to go into effect on Chinese imports, I think we're going to see the U.S. asking more and more of that of U.S. trading partners. Now, Mexico is much more reliant on the United States than it is on China. I don't think every country is similarly situated in the same way, but there is this concept of changes to rules of origin that we've talked about and the administration has teased. And I think what that means is the U.S. is going to be seeking from trading partners that if you want access to our market, you've got to limit the Chinese content that is in the goods that are coming into the United States. And I think, to your point, that's going to cause more friction between the U.S. and China.
A lot of companies and economists have talked about how peak tariff uncertainty is behind us, and that's unleashing a lot of optimism at companies who feel like they at least know some of the rules of the road. Do you think that that's right and that actually there's room to de-escalate further, to see even a further softening in tone, especially ahead of next year's midterm elections?
Yeah, my sense has been that where things are right now between the United States and China, which is something like a 30% to 55% average tariff rate, depending on the good, where we have talks that are ongoing, but we're still separately taking national security and economic measures that may discriminate against the other. I think this is more or less the status quo. And while the numbers may shift around one way or the other, I think this is as stable as things get. And frankly, I think things could go the opposite way. If a year from now we still have China buying loads of Russian oil, if we still have China looking to be slow walking some of these discussions, if they're cutting off exports of rare earth magnets, this relationship could actually fall off a cliff and get much more unstable. But I think sort of best case scenario from an investor perspective is probably the status quo right now.
Kellyanne, thanks for jumping on. Kellyanne Shaw there, the former senior White House trade advisor. That's how markets view things. So long as there is no escalation, we're okay with that. But ultimately, when you look at the chessboard, to Kellyanne's point, it looks like further escalation is there. The recipe's there, ready-made, further down the road.
If the best case scenario is preserving the status quo, it raises the question about whether people are underpricing the risk for a true escalation or whether it doesn't really matter because companies have immunized themselves sufficiently to some of this uncertainty by, putting robots in the place of all of us.
The market just wants to move on and focus on other things, and it's focused on AI, robots, and all of those things.
Yeah, innovation, how much companies can really shift around some of their supply chains more quickly. And honestly, the adjusting and the adapting of American companies has been really surprising.
Which is why the Nasdaq's on a 9-day winner streak, and it's about to be day 10 based on this price action. Futures up again. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Just doubling down on that Tesla news you mentioned earlier, the National Highway Traffic Safety Administration is investigating issues with door handles on 2021 Model Y vehicles. The move comes days after a Bloomberg investigation uncovered a series of incidents in which people were injured or even died after being unable to open doors when their cars lost power, particularly after crashes. Meanwhile, the FTC is probing Ticketmaster over whether it's done enough to keep bots from illegally reselling tickets on its platform. The investigation is focused on Ticketmaster's compliance with the Better Online Ticket Sales Act, which makes it illegal to use bots to bypass ticket limits for popular events. A decision on whether to bring a case could be made within weeks. And retired NFL superstar Tom Brady is getting back on the field for a flag football tournament in Riyadh next March. Brady made the announcement alongside Turki Al-Sheikh, a Saudi Arabian sports promoter. Other celebrities and athletes are also expected to join in on the game. Flag football also will be introduced at the Los Angeles 2028 Summer Olympics. That's your Bloomberg brief. John?
Wait, one, that's ridiculous. Yahara, thank you. Is that true?
Well, maybe it'll be
flag football at the Olympics.
Maybe it'll be the next breakdancing.
How much is Brady getting paid for that?
I mean, well, you can imagine, given some of the money involved in this. Do you think he feels like he's disgracing his former profession by doing flag football, or do you think he's embarking on a support of youth and protecting
definitely the latter,
Yeah,
of course. Yeah. I think there's a price for that.
Yeah, you think so?
Without a doubt.
You played flag football?
If you paid me as much as he's getting paid to play in Saudi Arabia, I'll happily play with you anytime you want.
All right,
We'll go play flag football at the Olympics together.
All right, well, we'll do a crowdfunding.
Just like the breakdancing, maybe Australia will give us a place on a team, you know?
No,
go and do that?
No one needs to see that.
Okay.
There's certain kinds of publicity no one needs.
Let's move on. Up next on the programme, unleashing a bond market rally.
The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Our policy rate is restrictive, modestly so in my view.
We'll get to that in just a moment with Ian Lingen of BMO Capital Markets from New York City. You're watching Bloomberg TV. Stocks are positive by 0.1%. Up this morning by 0.15%. On the Nasdaq 100, higher by 0.2. In the bond market, check out the 10-year. Haven't had a close below 4%, so in the threes, I think, since April 4th. And we were only there for about one session. On the 10-year this morning, 4.04%. Just about holding on to those levels this morning. And the surveillance this morning, unleashing a bond market rally.
The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Our policy rate is restrictive, modestly so in my view. The stability of the unemployment rate and other labor market measures allows us to proceed carefully. While the labor market appears to be in balance, it is a curious kind of balance. Longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored.
Chairman Powell setting us up for rate cuts as the 10-year bond yield hovers near a 5-month low ahead of the first expected interest rate cut of 2025. Ian Lingen of BMO writing the following: we're encouraged by the modest bid for treasuries. This does trigger our concern that investors are looking for a more dovish cut than Powell is going to deliver on Wednesday. Ian joins us now for more. Ian, good morning.
Morning. Happy to be here.
Great to catch up with you. Let's talk about the bond market rally so far this year. Outperforming. The bond market bid has returned to treasuries. Let's start with why. What's driving that move for you?
So I think there are two main factors. The first is we got through the period of being concerned about a buyer strike in treasuries. Now we know that there's demand at the auction. Now we know there's plenty of demand in the secondary market. The second major issue is that the period for tariff pass-through to really move the inflation complex has largely passed. Now, that doesn't mean that there won't be upward pressure on goods inflation as a result of the trade war, but because it wasn't condensed into a 3-month period and is going to be spread out over 12 months, maybe longer, that means that the market can move on to trading what's next, and what's next is the resumption of normalization.
Do you think that it's a paradox to see both a rally in the bond market and a rally in risk assets that seem to be really hedged on this idea of a reacceleration in growth?
So I have been very surprised by the resilience of the equity market and the fact that we continue to move higher and higher and set new records every day. However, if we put it in the context of a monetary policy adjustment lower that is still holding out hopes for a soft landing, I think that higher equity valuations make sense in that context. It's not until we get a bigger spike in the unemployment rate or a slowdown on the consumption side that we would really start a conversation about a recession. And barring that, as long as the Fed is in motion towards lower rates, I don't think that there's a reason to sell.
Is there a trigger point in terms of 10-year yields that signals to you that we really are seeing weakness, bad news is bad news, versus just simply people getting stomped out of their short, long-term treasury positions and being forced to buy?
I think that at this stage, given how positive term premium is, particularly further out the curve, that we would need to see 10-year yields below 375 or even 365 before I would characterize that as anything more than just going back to the prior range. So we could drift lower in rates just through the process of normalization.
When we quoted you, we talked about the risk going into Wednesday. Just elaborate on that. What is the risk going into tomorrow's decision?
So the market is poised for a very dovish takeaway from Powell. But the reality is, if he goes 25, that means that we're still restrictive. We're slightly less restrictive than we have been, and he will justify continuing to remain somewhat restrictive in all the uncertainties. And so if the takeaway is that we're not starting 25 basis points per meeting, and instead it will be meeting by meeting, I think the market sells off.
How much weight will you put on the dot plot?
The market loves to trade it, and it gets revised all the time. So I'm cautious about assuming that that gets realized.
Do you think that markets have really grappled with the idea of Fed independence, or have they just shrugged it off and say, what does that mean? How can we really even know? And ultimately, whoever's on the Fed board will do the right thing for the economy at a given time, right? So what's the sort of pendulum there for when that starts to matter again?
So if the Fed didn't have the justification of slower payrolls growth and the benchmark revisions lower, I think we would still be having a conversation about Fed independence. But the fact of the matter is the data has caught up with the pressure that was coming from the administration, and so Fed independence can be preserved while still cutting rates.
So we're about 36 minutes away from the retail sales figure that we get out from the United States. And a real question of how to read this, right? What are you looking for to indicate whether this builds on soft payrolls data or whether this kind of flies in the face of that and points to a lot of confidence by consumers?
Well, from a GDP perspective, we look at what's called the control group, which backs out all the components that don't flow through to the GDP consumption figures. And so that'll be the key. And if it is 0.5, 0.6, I think that that's going to be a strong showing for a month in which we saw weaker payrolls growth.
There's another data point in the mix as well this morning that won't get as much attention. Import prices. Mm-hmm. How important is that as an input to gauge who's paying the tariffs right now and who isn't?
Well, interestingly, import prices at this stage are not going to be as relevant to the tariff discussion. They will be more relevant to putting the final estimates on core PCE for this month, or for the month of August. And I think that that's going to be important because we're tracking at 0.18, which means a very benign print on the Fed's preferred measure of inflation.
Ian, always appreciate your time. Ian Lingham there of BMO Capital Markets. The pass-through, not as obvious right now, but based on experience, it hasn't been the exporters selling into America that have been cutting their prices. It's been domestic companies taking a lot of this on margin, it seems, based on the data we've had so far.
Yeah, or even cutting back expenses in a variety of different ways, which is one reason why people have been looking at innovation or even job cuts in order to respond to some of the tariff costs. It's a complicated picture. Even retail sales, how do you interpret that when so much of the retail sales comes from the wealthiest households? It's very difficult to sort of parse this out and come up with a comprehensive or consistent story.
Are you ready to talk about dot dispersion in the dot plot?
I have a treatise.
How concentrated they might be?
I have a treatise on dot dispersion that I'm going to whip out tomorrow, and it's going to be beautiful.
I'm looking forward to the coverage.
I think everybody
What do you think Stephen Miran's going to be? Is it going to be a throwback to Jim Bullard from all those years ago? Just put the dot at the very bottom of the dot plot and just put it out there for several years?
It depends. It depends on whether he actually wants to have a seat, a permanent seat on the Fed, or whether he's a placeholder to try to be a rabble-rouser. And we'll find out.
Coming up tomorrow, we'll have special coverage of that Federal Reserve decision on the trading floor at Bank of America. Look out for that tomorrow morning. Coming up next, we'll catch up with Alicia Levine of BNY Wealth, Ron Josie of Citi, Steve Rasciuto of Mizuho, Christina Campmany of Invesco.
What is not baked in is the idea that we may actually end up needing these cuts.
Right along with everybody else, I expect a quarter-point cut.
We don't see the economy going to above trend growth. So this is a kind of a muddling through scenario.
I don't think anyone would be completely shocked by, a more dovish bias here.
If they do 25 bips or if they do even 50, the market should be able to take it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Bill Dudley really sticking his neck out there. 25 basis point rate cut coming to you tomorrow afternoon.
With that tone, too.
Yeah.
Like everybody else.
Me and everybody else. From New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 up again by 0.14 on the NASDAQ. The longest run of gains we've seen on the NASDAQ 100 going back a few years. We're up again this morning by 0.2%. In the bond market, can we break down into the threes again on 10s? 4.04%. The fate of that move in the hands of this one right here, 29 minutes away. US retail sales, the next big data point for this economy.
Yeah, does it really confirm some of the strength that we're seeing in corporate earnings, or does it confirm the weakness that we're seeing when it comes to the payrolls report? There is a contradiction right now that the markets need to resolve. Are we truly seeing weakness that is the reason why the Fed is cutting? Or are we seeing something that is temporary at a time when companies are still building on profits, a soft patch ahead of what could be a reacceleration with Fed cuts next year?
It's interesting what Deutsche Bank had to say on this issue. We talked about the step down we've seen in payrolls growth, the step up we've seen in the equity market off the back of the increase in expectations for interest rate cuts from the Fed Reserve. And he essentially said, the step down you've seen in payrolls growth isn't because the economy's weak. That might drive the Fed, but it doesn't drive us. He thinks that's a bigger consequence of what's happening on the supply side. The break-even rate for the labour market is a whole lot lower. And you should just take the rate cuts as a bonus because he thinks the economy's doing okay. And the bigger question you've got to ask yourself is just how hot this Fed's going to run this economy as a consequence.
In the past 2 weeks, the St. Louis Fed put out a report that said earlier this year they expected the break-even rate for the jobs number had to be something like 150,000 new jobs created every month. They have recently revised that to as low as 50,000 a month, just simply because there are fewer immigrants coming in to the nation. There's some that are leaving. So that really highlights exactly the point that Deutsche Bank is pointing to, that the headline number really doesn't tell the story.
Retail sales, 8:30 Eastern Time, the next stop for this big debate. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth. The stocks trade at all-time highs. Ron Josie of Citi as Alphabet joins the $3 trillion market cap club. And Stephen Rasciuto of Mizuho as we break down the latest data. We begin this out with stocks steady ahead of a key Fed meeting. Alicia Levine of BNY Wealth writing, we think the Fed cuts twice as inflation remains a problem, but the Fed is cutting into increased earnings estimates. Alicia joins us now for more. Alicia, good morning.
Good morning.
Do you think this Fed's about to run it hot?
It looks like the Fed's going to run it hot because there are disparate signals in the economy. So the job losses that we saw from the BLS survey from the previous year, the revisions are suggesting just much, much slower jobs growth. And the models have actually not caught up to the fact that there might be a new equilibrium in job creation for keeping the unemployment rate in the low fours, which is the signal. So the Fed's going to cut. It looks perhaps more justified than it did 2 or 3 months ago when this conversation started in earnest. And look, the market's already priced in something like 140 basis points into the end of next year. So it's already in the market.
Well, let's just stay on the labour market just for one more beat. You believe that the step down we've seen in payrolls growth overstates the broader weakness in the labour market?
So I think it's real. It looks like to be a no hire, no fire economy. It is very clear that the younger cohort is having trouble achieving that first job. We've seen it all over the New York tri-state area this summer, people without jobs who just graduated some very fine universities. So that's very real. But the issue is that the firings are not necessarily happening either. We also see that productivity was ratcheted upwards for the second quarter. So it looks like productivity is coming in to support the economy, perhaps not running inflation hot because of it, and at the same time, just maybe a reluctance to hire labor until policy is clearer. But it also seems clear that the equilibrium rate is just simply much lower. Otherwise, we'd have a higher unemployment rate.
But John and I have talked about this extensively. Is this a gap, the gap between corporate earnings and the number of jobs getting created, that has to close? Or is this the new paradigm?
So I think we're in a structural shift. I think we're living through one of those shifts where there are different parts of the economy working at different speeds. So the increased earning estimates are coming from the tech sector, the communication sector, which are not hiring. And yet the margins are going higher, revenues are going higher. And so that's what's driving the earnings estimates. In the end, our faithful S&P is not the real economy. And those two things can exist separately, a weaker labor market along with stronger earnings. Now, at some point, the bifurcation has to be met, meaning you still need positive growth to generate earnings. You can't have negative growth. You can't have a recessionary scenario. But what you have is massive household wealth that's been created in the 60% of households that own equities, 40% which own real estate. And so you're supporting the consumer through financial assets. So we financialize the economy, we financialize consumption. The numbers are in the aggregate. It is definitely a K-shaped economy when it comes to consumption. The lower quintile is not doing as well. They borrow short. They're renting, they're not owning, they don't own financial assets. But the numbers themselves are in the aggregate, and the aggregate's being driven by the top 3 quintiles.
So we're 24 minutes away from these retail sales. And this really has been the question. Can you keep seeing those retail sales come in hot, given the fact that we do see this backdrop of a labor market? I mean, it's not the computers, it's not the robots spending money, right? Is this going to be the new paradigm where your stock prices go up so you can spend money, but jobs are really not plentiful? Is that kind of what we're looking at?
I don't know if I would put it necessarily that way. I think we have a gap. We have a gap in the labor market as we see where AI is taking companies and how much labor is actually needed. In the meantime, will the Fed be running the economy hot? It looks like they're going to run the economy hot.
And we've seen what we've seen in the equity market. Small caps are starting to outperform. We've seen that captured in the Bank of America Fund Manager Survey as well. That feels almost exclusively like an interest rate-driven story. Do you see the outlook and the pickup in the outlook, the improvement, justify the move we've seen?
So, as you said, the small cap move is all about a bet on rates and the direction of rates. What's interesting here is that actually the equally weighted S&P is making new highs as well. So the broadening of the market is happening, and actually earnings estimates and growth estimates for 2026 are moving upward. We'll just point out there's $150 billion of consumer stimulus coming in the first quarter of 2026 through the tax bill. You know, the tax bill is not talked about. We talk about tariffs all day long.
Well, let's do it now.
But there is an offset through the tax bill, which is helping to drive healthier corporates and actually offset some of the costs of the tariffs on the margin line.
What are we expecting to get in that tax bill? What's in that tax bill that's going to drive this reacceleration? Because you're not alone. I've heard a lot of people say this, that you're going to see a reacceleration juiced by what was just delivered. Now, other people would sit around the table and say, that was just an extension of current policy. Don't read too much into it. What's fresh in it? What's important about it?
So the no tax on tips is there. The tax refunds that are coming, the support for families as well is coming all in that first quarter, and the refunds from the IRS to households, and it's all focused on the lower income cohort. So that's out there as well. So you may have a pocket here of, tariffs are moving higher. We had about a 10.5% tariff rate for August. Likely to move higher because the statutory rates are a little bit higher, but then you're having consumer support on the household level, and at the same time you're having for the corporates capex and investment being incentivized and offsetting some of the hit from the tariffs. So you've actually tried to sterilize some of the hit from tariffs while you're bringing revenue into the country. Is this the most efficient way to do it? Of course not, right? Tariffs are not an efficient policy, but it is a revenue source, and it is a way to offset some of the other priorities.
If I were the CEO of a retail company and I heard you talking about this, I'd say, all right, I'm not going to pass along the costs right now to consumers. I'm going to wait until the first quarter, and then I'm going to pass along the costs because they won't care as much if prices go up just a little bit. Why is that not dramatically inflationary for the remainder of 2026?
So it could be inflationary. It could be inflationary. I mean, we've seen retail companies are saying that they've already started to pass on low to mid-single digit costs to the end user customer, and there has not been any pushback. The question is, if you get to double digits, is there pushback? So I think it's a slightly higher inflationary world. I think tacitly the Fed is saying 3% essentially here, tacitly. Okay, but it's baked. What are they going to do with a degrading labor market? And that's the problem. If they're data dependent, the data has said the jobs market has slowed, and thus far we have not yet seen a huge hit from tariffs on the inflation side, and so they're in a really difficult place. But the cuts are already baked into the market. So what's the risk here? The risk is that, at some point next year, the Fed says, look, we have to actually hike. Right? That would be a huge risk to the market. That is a tail risk that's not baked in. We don't think that's likely because ultimately we see tariffs as a tax. It's a tax. So yes, you get that inflationary spike and then you get the growth effects pretty quickly. And so we don't think that inflation lasts very long.
How much does 1 percentage point change things when you say that they're tacitly accepting 3 and they're no longer targeting 2? How big a difference is that?
I think that's a huge difference. And I think you see that in the dollar. I mean, I think that the weakness in the dollar is reflecting that, the Fed may be moving. Like, they're not saying they're moving off, but if they're cutting here with CPI at 2.9%, right? So it's a fact. It's a fact. And so I think it's a bit of a muddle through here. Now, ultimately, if there are growth effects from the tariffs, their tax, the inflation is going to move down at some point.
Listen to the conversation we're having, though. Over the last summer or so, the last several months, there's been this freak out about political capture of the Federal Reserve and the potential for a de-anchoring of inflation expectations. And what I hear from you is that the biggest contribution to that story right now, it's not the White House, it's the way they've been conducting policy over the last several years.
Well, because if you say data dependence, the inflation has not really come through. It's come through on the goods sector, but it hasn't come through anywhere else. And inflation on services is still moving down. You have not seen a huge inflationary hit from the tariffs. What you have seen is a degradation of data in the labor market. And so if you say you're data dependent, that suggests a backward-looking view and not a forward-looking view. I think they're in a very difficult spot here. Like, I don't think this is an easy call. It really is not. Like, people sound very certain about this. It's very uncertain. And so I think that, ultimately, if you believe that if you believe the models on tariffs are wrong, right? Because we still have not had our stagflation yet. Right? Where's the stagflation? It's waiting for Godot. It hasn't happened yet. So if you believe it's a tax, then the slowdown is coming.
Alicia Levine of BNY. Alicia, it's good to see you.
Nice
Thanks
to
for being
see you.
here. I'm pleased Alicia said that. I think it is a difficult moment for the Federal Reserve, and I think it's going to be very hard for the chairman to form a consensus on the committee over the next 24 hours.
Especially because a lot of economists and a lot of people who grew up during the financial crisis really are predisposed to being more worried about the scarring in the labor market than they are about inflation that went back down to zero very quickly. So how does that change the view, given that this is a new, different paradigm?
You can get people on side for a risk management rate cut, something like that. To get them on side for something bigger, more aggressive, something that arguably the market is priced for over the next 12 months is a very different story.
It's a difficult moment for the Federal Reserve, especially with all of these other influences, whether it's AI and the potential productivity, whether it's immigration, or whether it's the question of how companies are adapting to tariffs.
That Federal Reserve decision about a day away. Equity futures into that positive again by 1/10%. With an update on stories worldwide with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. The Fed's two-day policy decision getting underway today, and both Stephen Miran and Lisa Cook are set to be there. The Senate confirmed President Donald Trump's economic advisor Stephen Miran to the Board of Governors last night, and a U.S. appeals court blocked Trump from removing Cook from her post, though Trump could still ask the Supreme Court to step in. Meanwhile, Luigi Mangione, the suspect in the murder of United Healthcare CEO Brian Thompson, is due in court today. His lawyers are pushing to have his state murder charges thrown out, arguing that the New York case and a parallel federal death penalty amount to double jeopardy. The judge will also decide a trial date and whether the state or federal case will go first. And Bloomberg News is out with this year's rankings of the best business schools around the world. And for the 7th year in a row, Stanford University comes out on top with the best full-time MBA program in the U.S. The University of Pennsylvania's Wharton School came in second, followed by the Haas School in Berkeley, Harvard Business School, and Northwestern's Kellogg School. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. Up next, the Morning Calls Plus. Ron Josie of Citi as Alphabet joins the $3 trillion market cap club. That conversation up next from New York City this morning. Good morning.
The big driver of earnings, we have to be realistic, is the AI investment boom, right? That is what's got everyone's attention. And whilst the earnings are good overall, that has been the kind of central piece. That's been the biggest driving force in the second quarter earnings. And this year, we're still waiting a little bit for that broadening out of profits to come. We think it will come. We think it comes into next year. We think next year, by the way, is better for earnings overall than this year.
Paul Quincy at JP Morgan Asset Management goes some way to explain the all-time highs in the equity market despite this big step down we've seen in payrolls growth in this economy. Equities are record highs coming into Tuesday. We add to them, up by 1/10% on the S&P, on the Nasdaq up by 0.2 as the Fed's two-day meeting begins tomorrow. Special coverage from the trading floor at Bank of America tomorrow morning. For the team here at Bloomberg Surveillance, we'll have the market voices, Mark Cabana, Savita Subramanian. We'll have the C-suite as well, co-president Jim DeMar and the chairman and CEO, Brian Moynihan.
I am thrilled to be there again and get their view, especially given how complicated this meeting is. It's not just about whether they cut 25 basis points, whether they cut 50, what they signal going forward, but how they view an economy that is dramatically in flux. And that, I think, is a fair way to describe what we're looking at.
Looking forward to that coverage tomorrow morning. For now, though, let's get you some morning calls. First up, Morgan Stanley reiterating its overweight rating on Tesla, calling the full self-driving software a game changer. That stock is up by 1%. Your second call from Goldman Sachs, double upgrading Hershey to buy from sell. Just don't tell Bramo. Expecting outsized growth from recent pricing
My
announcements.
kids are thrilled, don't get me wrong.
Bramo earlier, calling it barely chocolate.
Well, it is technically barely chocolate in the United States.
Just about.
Anyway, we can move on.
Stock is up.
Kids buy it.
By 1.3%. And finally, Bernstein lowering its price target on FedEx to $247. Kids buy it. Amazing. Reflecting a headwind from the end of de minimis exemptions, that stock is up by 0.5%. Lisa, never change. Let's turn to tech. Ron Josie of Citi boosting his price target on Alphabet to $280, believing in greater demand and improved profitability at the company. Alphabet now valued at more than $3 trillion. Ron, welcome to the program. What a milestone. I remember not so long ago we were waiting for the first $1 trillion company, and here we are talking about threes, fours, fives, sixes. I don't know where this one's going. Ron, when I go through your note, what stands out for me is just execution, execution. What's changed about their approach in the management team?
Well, I'll tell you, not only the valuation just on a market cap, interesting to talk about. This is a business that's been around for, two and a half decades or more, actually, and search is still growing, call it low double digits, 11, 12, 13+%. And then you have newer business coming on, such as not only YouTube, but you have Google Cloud. And so what we're seeing is a business that is now embracing and has the right products, it seems, at least the right product roadmap to better attack the generative AI world. And, it's very clear that search is emerging to maybe more of an answers engine, right? And people's use cases are changing in terms of how we use Google. But at the end of the day, we look at our numbers, we're looking at double-digit growth for the core search business. We're looking at greater demand for Google Cloud, and all that is flowing through to increase profitability. And so we think execution is just improving quite a bit.
What's changed for you over the past couple of months to give you confidence that Google can adapt to a very new moment where OpenAI is an incredible competitor to their main core business?
Yeah, Lisa, it's a bunch of things. And so we've always been of the view that Google's product Halo helps to keep it in the mix or in the loop of everyone's lives. So in other words, of course, we all use search, we use Maps, we use YouTube, Gmail, and the list goes on and on. And so it was a matter of time until, call it Gemini, or we figure out how to better incorporate generative AI tools into the core search product. We're not quite there yet. We're learning still. I think AI overviews, AI mode is helping. The core Gemini app is helping. But at the end of the day, we're seeing Google's tools being more widely adopted. And that's the key thing. I mean, we have to remember, Google has, 7+ products with more than 2 billion monthly active users, 15 more than 500 million. They have the size scale. It was a matter of time until Gemini and other products actually got to that level. To be clear, search remains, a big question mark, right? Where do we go? And we've been nothing but impressed with what's going on at ChatGPT and what OpenAI has been doing in terms of just bringing innovation to market. But that doesn't mean Google's standing still. And I think that's the key point here in our view on Google.
I do wonder going forward whether Google will be viewed as a search company, whether it'll be viewed as a phone company, an increasing competitor to Apple, especially with some of their AI adaptations that are exceeding what we're seeing from AI, or whether they're seen as some other device company or cloud computing company. What is this company going to look like in 5 years?
At the end of the day, it is full on a technology company. It's an app company. I view it as primarily a consumer company. What's new here over the past couple, call it year or so, is that Google Cloud now has more products and services to offer their clients. And so whereas a few years ago, the SaaS world was primarily AWS, and of course, Azure was doing their thing. And all of a sudden, with Gemini, Google Cloud now has more than a seat at the table, seeing revenue reaccelerate here, and their commitments in terms of their backlog is growing quite handily. So you ask, what is Google over the next couple of years? Look, I think search is going to evolve into, we'll see, maybe more of an answers engine. We'll see how Gemini and AI mode and AI overview and core search sort of merge into one as the Google Cloud business continues to just take more share of the corporate spending market. And I think you're exactly right. We've got the Pixel phones. We had their Made by Google event about a month ago with more hardware devices coming out. We can't sleep on YouTube. And so there's a lot going on. There's always been a lot going on within Google. I think for now, we're seeing this sort of greater clarity on strategy. And, I think it's also important to say, post the memorandum of opinion from Judge Mehta, I think it was on September 2nd, we now have greater clarity on potentially where some of these, the search distribution trial and maybe other trials might go. And I think that actually helps from a product innovation perspective as well.
Ron, can you just build on that? Chrome and keeping hold of Chrome, they have something that many others wanted, including the other AI players. Based on the reports, Perplexity were interested in acquiring that asset. How important was it for Google to hold on to Chrome, and what does it do for the overall business?
Yeah, no, look, I think Chrome has around 2/3, if not more, market share of the browsing market. Look, I'm old enough to remember when we were in Browser Wars 1.0, 2.0, and here we are again. And look, Chrome with 2/3 of the market here in the US, the entry point to the web on so many different things, including search. I think it's a strategic asset that Google has built over close to 2 decades, I think 15 years or so. And so to see a structural change on a distribution case, it seemed a little aggressive, and that's what we got with the judge. And so now that Google owns it, I think you're going to see Chrome be more that agentic browser. We're going to see Gemini be more infused throughout it. And as that happens, usage should still go up. And at the end of the day, the internet is all about engagement, whether that engagement is through a browser or maybe through glasses or the phone. I think Google has the tools to keep themselves in front of everyone's lives.
Ron, just in 45 seconds, which is tremendously difficult to do, will that continue to be the entry level to the internet? Aren't we moving away from that? Aren't we moving away from how we traditionally engage with the internet?
I firmly believe this. I think how we interact with apps, how we use the web today, how we sort of just do anything on the web is going to change in the next 3 to 5 years, thanks to generative AI. That doesn't mean that a lot of these companies, such as Google, are going to stand still. And so, later this week we have Meta Connect coming out. We'll see a next incarnation of their Ray-Ban glasses, which is exciting. How we access the web is changing. Generative AI or search is now becoming more an answers engine. And so as we think about this, I think Google is front and center in terms of where these changes are going. So I think it's a fair question.
Let's get you in the studio next time for a longer conversation. I enjoyed this, Ron. Appreciate catching up with you after that call. Ron Josie there of Citi with the latest on Alphabet.
Yeah, and you made a great point about that case and how much that really unleashed Google's willingness to invest in Chrome and make it agentic to tell us everything we might need to know and even some things we don't want to know.
Stock is up by another 0.6% so far this morning. Coming up, retail sales in America, the latest data in the United States going into that Fed decision tomorrow. Steve Rasciuto of Mizuho will be here to break down the numbers from New York City. You're watching Bloomberg TV. US retail sales about 25 seconds away. Going into it, the score's shaping up as follows. Equity futures on the S&P 500 up by 0.1%. On the NASDAQ 100 up by 0.16, a 9-day winning streak on the NASDAQ 100. Switch at the board and get to the bond market. 2-year, 10-year and 30-year. 10's very close to a 3 handle, 4.03% this morning. 2's at 352.41. As the Fed meeting begins and concludes tomorrow, we've got some economic data to get through. With that data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, there's an old saying, don't stand in between an American and a cash register. And it looks like that was the case. Retail sales a much stronger than expected 0.6% gain after a 0.5 in the month of July. The survey thought we'd only see 0.2. And a lot of the weakness was expected to be in automobiles. Retail sales ex-autos up 0.7%, ex-autos and gas up 0.7%. The July numbers have been revised higher with advance headline sales up 0.6 instead of 5, and ex-autos up 0.4 instead of 0.3. Now, the control group, which is what everybody watches, it goes into GDP, basically up 0.7% after a 0.3 gain in the month of July. The forecast was only for 0.4, so it looks like it was a very strong back-to-school season, and it looks like Americans were not put off by tariffs, at least not during the month of August. The other numbers we're just getting in here, import prices up 0.3%. That's down 0.1 from last month. The expectation was for them to fall 0.2. Ex-petroleum up only 0.2% from a 0.3 in July. But here's the key. If they aren't going down, it suggests that exporters are not absorbing costs of tariffs, that they are just passing along their normal prices or increasing them a little bit. So that would put the onus of tariffs on the importers, on wholesalers, retailers, and to a certain extent, the American people. But the American people look past it, it looks like, in the month of August.
Michael McKee, stay close. Credit to Adichie Bave and the team over at Bank of America who were looking through their card data and essentially told us on this program that they saw a consumer re-engaging with the economy and spending was picking up. You see that captured in the retail sales print so far this morning. The market reaction is curious, so let's get into it. Equities stay higher by about 0.1% on the S&P and the Nasdaq up by 0.2. Push it through the bond market. I think there's a conclusion that this does not change the story at the Federal Reserve. They cut interest rates tomorrow. The 2-year stays anchored around 3.50. Further out, yields up just a little bit, but not too much. Up by a single basis point of 4.05%. I do wonder to what extent this changes the conversation just on the margins, Lisa. How aggressive can you be at the moment with interest rates if you've got some data telling you that maybe the weakness in payrolls is not evidence of more broader weakness elsewhere? That
this is a low hire, low fire jobs market and people are still spending. It doesn't indicate a market or an economy, rather, that's about to tumble into recession. I'm trying to understand this market reaction. I find it really curious, especially because there's even a little bit of dollar strength coming in on the heels of this, even though it seems like the Fed would cut rates regardless of the fact that consumer spending is coming in hotter than expected. If you want to add to the confusion, even the revisions to retail sales from the prior month were revised upward. They were not revised downward. So across the board, you're seeing this momentum coming into today. The only thing I can think of is maybe the New York Fed Services business activity came in lighter than expected. But if you're going to hinge your entire market bet on that, well, this is a market that's changed.
Yeah, you're scraping the barrel.
You're scraping the barrel.
You're reaching for that this morning.
Exactly.
This is good data. It's better news. Mike McKee, I want to bring you back into the conversation. We know who will be around the table. Governor Cook, Governor Miran. Talk to me about, now they're looking at the totality of the data, how things are set up for them tomorrow.
Well, it's an interesting situation with retail sales. Of course, this is a smaller part of overall spending than services, but we're seeing some strength in just about every category, including the things that have been tariffed. Electronics and furniture stores up 0.3%. Furniture and home furnishings were down by 0.3%, but health and personal, gasoline stations were up 0.5%. Gas prices did go up. Clothing and accessories up 1%. You'd expect that in back-to-school times. Non-store retailers up a strong 2%, and food services and drinking places down a little bit from what they were last month, but still up 0.7%. And that's the discretionary part of retail sales. So we're seeing strength for the American consumer. And if the American consumer is going to keep that up, then the Fed has a question to ask about how much it needs to cut rates.
Mike McKee with the latest. Michael, thank you. I mentioned Governor Lisa Cook. So the latest news overnight. We woke up to this, happened yesterday evening. An appeals court blocked the White House from removing Federal Reserve Governor Lisa Cook. Just a headline crossing a Bloomberg terminal. This coming to you from Reuters. The White House to appeal that court ruling on the Fed to Lisa Cook. Not exactly surprising. Largely expected.
Yeah, the question now is, will it go to the Supreme Court, given the fact that it was an appeals court that did rule 2-1 to keep Lisa Cook in her seat as the adjudication of the actual case goes forward. A real question here about whether the Trump administration's appeal is intended to go to the Supreme Court in an emergency injunction ahead of today and tomorrow. It seems like Lisa Cook will be at this meeting. Beyond that, I don't think any of us are thinking too far.
That drama continues. The latest in this market, an upside surprise on US retail sales. The control group, positive 0.7%. The estimate in our survey, we were looking for 0.4. With us around the table, Steve Rasciuto of Mizuho. Steve, good morning.
Good morning.
It's good to see you, sir.
Thank you.
At the epicenter of your research, I think you're cool at the moment. You asked the right question. Just how restrictive is monetary policy? Clearly, the Federal Reserve's got one opinion on that. What's yours?
Well, the Federal Reserve opinion is 3% is neutral. My view is 4% is neutral. So we're a heck of a lot closer to neutral than the Federal Reserve would be assuming. The difference between us is what you assume for the real underlying rate of interest that's required in the economy to achieve the Fed's balanced trajectory of long-term maximum sustainable employment and low inflation. The Fed thinks it's 1%. We think it's 2%. So if the Fed's credible at a 2% inflation rate, which is arguably questionable as well, then you're at 3% or you're at 4%.
I'm trying to understand this market move. I can't. Can you explain this to me? Why is the bond market just not doing anything on the idea that we got retail sales that were hotter than expected across the board, and it seems like the U.S. economy is doing just fine at a time when, yeah, the headline payrolls number has come in, but a lot of people are saying that's appropriate given some of the demographics? You know, you're asking the question is, where have all the bond vigilantes gone? And the answer really is they're all either indexers or closet indexers. So all they care about is the performance. It's number one. Number two, there is a global deflationary force out there. Number three, it's hard to short a market in front of the Federal Reserve cutting interest rates, which they're going to do. And then there's a fourth consideration, which is for a lot of people in the marketplace, these levels of yields are attractive. Because they really have never witnessed substantially higher levels of yields. And every time there's been a backup, they've done well by buying it. So you're in an environment where you're expecting the Fed to cut not only once, but potentially 3 times before the end of the year. They're not going to do a jumbo rate cut, although there will be voices around the table for a jumbo rate cut. So in that environment, it kind of makes sense for people who just won't short this market. And if you won't short it, it's hard to make it go down in price. You said something in there that there's a global deflationary force. Correct. If that's the case, why don't we all buy bonds? Because ultimately, then we're not worried about inflation anymore, and we're getting something real for our money. Well, that's exactly part of the problem. Is you have this global deflationary force, and the question is, you saw the import price numbers going up. They're still relatively tame. What is this deflationary force? What are you talking about? It's China. China is the global deflationary force. It's replaced Japan as the global deflationary force. It has to dump product around the world. And that's one of the reasons why I don't think you're seeing the amount of impact from the Trump tariffs. Because I think, even though import prices are going up, when you look against the tariffs, they're not going up as much. So I do agree that I think the importers are dealing with some of the tariffs, but I also think that people who are exporting are dealing with some of the tariffs, and it's getting absorbed that way. And I think there's an additional factor that people are fearful of in here, and that is whether or not this administration is going to attempt to do something like yield curve control by adjusting the long-term supply of Treasury debt. So when you roll all those factors we talked to together, you can see why it's hard to get the market to short in this environment.
Is that what you're expecting, some kind of yield curve control?
Well, that's the fear. I don't think Scott Bessent has moved towards it, but everyone is convinced he's going to if push comes to shove, because Donald Trump wants lower interest rates. And he has more room to go in terms of raising money in bills. Now, it's also interesting, despite all the money they're raising in the tariffs, you are seeing the budget deficit still deteriorate fairly rapidly. So there is going to be more supply coming down the pipeline, but they may wind up just doing it all in bills.
It's funny that when you talk about yield curve control, I think about monetary policy and you think about it coming out of the Treasury. How important is that distinction?
Well, there is a big distinction between the two of them because one is a function of a central banker making a decision based on a hard and fast policy rule, and the other is based on a political decision. And it's that politicizing of the interest rate environment that I think is a big part of the factor why yields can't go down.
How long can bonds and stocks keep rallying together at this point, given everything you said?
Well, the equity market looks pretty good. Look, my forward earnings numbers are very good. My earnings revision factors are very, very good. We haven't pushed multiples to any significant level. I think to get back to the question you asked earlier, which was why is the dollar not doing well? Why did the dollar sell off a little bit on this? I should say improve a little bit on this. And that is because people had been expecting 3 rate cuts. That was the potential. And I myself, when I moved from nothing, I said, might as well just throw in 3. Now you're in a backdrop. Now you're in a backdrop where, are you really just looking at 2?
So that's the reason why maybe the dollar is going to strengthen a little bit. Just going back to this, do you think that bond market investors, bond market traders are whistling past the graveyard just a little bit? Or do you think that they are right to focus on the overcapacity of China, they're right to focus on the ability of companies to adapt and adjust and say, ultimately, this will be a soft landing?
If yields were higher, I'd be more convinced in answering that question, yes. If we were in that 450 area, I think then you could sit there and say maybe the bond market is correct and will hold in, because at least I'm being rewarded somewhat for the risk I'm taking, because I've already got an inflation rate running at 3. Right now, I'm getting no protection from that inflation rate. I'm missing 100 basis points. That bothers me. And it should be bothering the investors. But again, how can you short it against all those factors?
Steve, going into the Fed tomorrow, just a final thought. What I've really sensed from you, from speaking to you, it sounds like you believe it's quite a mistake to anchor the view of the labour market just around a step down in payrolls growth. Is that a fair description of where you're at?
I'm disappointed by the labor force growth numbers. I think I understand what's happening. Companies that have seen their margins being impacted, or afraid their margins are going to be impacted, have opted for a more cautious route. But they're having to pay their employees more, and they're having to work their existing employees more, and they're still generating the income. I mean, is it a mistake to cut rates 25 basis points? Is it a mistake to get back to 4% on the Fed funds rate, which is where I think is neutral? No, you can live through that. Getting and saying we're going to get to 3 is where I have trouble with this market.
Do we get one or the other tomorrow afternoon? Steve Raschuta of Mizuho. Steve, thank you, sir. Good to see you. Thanks for giving us some time. Let's give an update on stories worldwide with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. Prosecutors in Utah are expected to file capital murder charges against Charlie Kirk's alleged assassin. 22-year-old Tyler Robinson is due for his first court appearance today. Investigators have used DNA evidence to link Robinson to the murder, including a screwdriver recovered from the rooftop where the fatal shot was fired. Meanwhile, President Trump has filed a $15 billion defamation and libel lawsuit against the New York Times. He's accusing the paper of serving as a, quote, mouthpiece for Democrats, and cites the Times' endorsement of former presidential candidate Kamala Harris. The New York Times saying the suit has no merit and that it won't be, quote, deterred by intimidation tactics. And week 2 of the NFL wrapped up with a Monday night football doubleheader that saw the Tampa Bay Buccaneers defeat the Houston Texans 20-19. Baker Mayfield led a game-winning touchdown drive in the final minutes to secure the victory. In Vegas, the Raiders fell to the Chargers 20-19 as Justin Herbert's 2 touchdown passes helped improve Los Angeles to 2-0 on the season. That's Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Up next, we'll catch up with Christina Campmany of Invesco with the Fed's 2-day meeting set to begin. Plus, Danny's got your morning movers going into the opening bell. Oracle getting a boost thanks to TikTok.
The reality is, if he goes 25, that means that we're still restrictive. We're slightly less restrictive than we have been, and he will justify continuing to remain somewhat restrictive in all the uncertainties. And so if the takeaway is that we're not starting 25 basis points per meeting, and instead it will be meeting by meeting, I think the market sells off.
That was Ian Lincoln of BMO, looking for 25 basis points tomorrow. And then the big question is, what comes next? Retail sales dropping just moments ago, about 20 minutes ago. Equity futures still positive by 0.1% on the S&P 500. On the Nasdaq, up by 0.2. A really decent upside surprise for the consumer.
An upside revision to the prior month across the board. Even the control group, which people look at, came in 0.7% increase versus the expected 0.4% increase. We also saw export prices increase more than expected. So why are markets not responding? Because essentially they had baked in at least 2 rate cuts this year, possibly 3. And it doesn't change the trajectory going forward, given some of the deflationary forces, as Stephen Raschuta is talking about, that people see coming down the pike.
I always say the first move is not always the right move, and we'll see if this sticks. But This is the move right now on the screen. Yields up by just a single basis point on 10s off the back of that better than expected data, 4.05%. Let's get you some single names. The opening bell about 42 minutes away. With the latest, here's Danny Berger. Hey, Danny.
Hey, John, what a run for Oracle. First, it was those AI-powered earnings. This time around, it is TikTok, with Trump confirming that some sort of framework is in place to reach a deal around this. Of course, Oracle was in the talks when we first had these discussions around TikTok remaining in the U.S. CBS News reporting that they are part of it this time around, too. Not getting any details on the structure of it, but nonetheless, shares are up 4.2%, just under that. Also, Tesla in focus this morning, with the National Highway Administration zeroing in and investigating their electric-powered doors, that great Bloomberg investigative piece that often they don't work when there are issues of power in the car. Shares are still higher, though. 1.2% still rallying after Elon Musk bought $1 billion worth of shares. So still getting a boost from that, not the regulators this morning. Finally, and I am so sorry to bring this one up again, but Hershey is still rallying, up 3%. One of the best performers of big cap stocks, because it got a double upgrade from Goldman Sachs, saying that not only are tariffs and price increases really well known, but it has pricing power, it's got brand names, so it's able to raise the cost of your K-Cap bar. John.
Don't apologise. I've enjoyed the Bramo rants all morning.
Oh, boy. I'm going to get
Danny,
so much
thank
hate
you.
now.
Appreciate it. More from Danny and Matt Miller in about 11 minutes' time with Bloomberg Open Interest. Let's keep it on this market and look ahead to the Federal Reserve. Christina Campmany of Invesco writing the following. The threats to Fed independence and data reliability concerns both should mean higher long-end rates and more term premium demanded. Christina joins us now for more. Christina, good morning.
Good morning. Thanks so much for having me.
The power of the word should.
Should.
That's not happening, is it? What is happening?
It's not happening just yet. We have seen steepening this year, and we have seen some of that, but it feels like the end of summer and the start of this corporate supply calendar that came back, and it feels like there's money just being allocated, and Steve spoke to it in the last segment, of just the outright level of yields. People say, okay, we're willing to put some money to work. But I think when we take a step back and we look at, there's a lot of big forces that are moving this year and big changes, and I think some of these, like Fed independence, what's going on with BLS, like these are big things and they will matter in the long end, in the long run, and in the long end for where rates are, I think.
So what kind of numbers do you think we should be thinking about? Because flattening resumed starting September. Yields started to come down at the long end of the curve. You're thinking about them coming back up to what kind of levels?
Look, I think getting back to 5% in bonds in the medium term is a reasonable number. We're 466, 467. I think that those are reasonable, and it should be a drift. I think, again, part of it is that the one point of the curve that has moved a lot is 10s, 30s, so there's some kind of reallocation of money. But I think you have to take a step back and say, like, where do we ultimately end with the Fed, and what are the underlying dynamics going on? We know that the Fed will most likely begin its easing cycle tomorrow. I think our base case is that it's a similar play out to last year, that they deliver kind of 3 to 4 hikes, 75 to 100, and then kind of assess where we are and where do we go from here. But is there scope for a lot more? Certainly with the changes in the Fed that are expected next year, I think that's
I guess part of the issue that I'm having, I'm still struggling with the market reaction from this data and what the signal is. And I understand, John, you are correct. The first move is not always the final move or the correct move, and there's a real question here about signal flow. But
it's interesting.
I think you can tell something by the fact that this market does not believe that you have strength in the economy turning into a reason for the Fed not to cut rates. Yeah. And it's not a reason to sell the long end either. So what will?
Yeah. Well, I mean, if you take a step back and you look at the price action in the last even 2 weeks, you say, like, the bond is rallying, stocks are at their all-time high, credit's almost at its all-time tights across the board. Like, these are very, very tight levels in credit. And you say, like, how do these pieces match together? And I think it's this shift from Powell that's reintroduced kind of the theme of last year of, we feel like we're tight from the Fed. We feel like we are at restrictive levels and we can deliver some easing, whether that is precautionary, preemptive, or I think once we got the payrolls report in August, like, ooh, maybe things are breaking more. So I think the market's still trying to weigh, like, is something really breaking, or is the Fed just trying to get a little closer to neutral, because 450 isn't neutral? And, like, the consumer has been very resilient all year. And I think you've had Michelle Meyer on here all year, and even the B of A retail sales numbers from their card data all year have said, like, the consumer is being resilient and is still spending, and they're choosier, but they're spending, and you keep seeing that. You see it in today's data.
Over the past couple of weeks, the U.S. bond market has outperformed other developed market bond markets, and I wonder if that's poised to shift. If you could see that change, if you really believe in this deflationary force, this doesn't look like a U.S. market that can continue to trade on weakness if these numbers that we just saw are correct.
Yeah, I think there are some kind of bifurcations that have to happen, and I think we take a step back and say, like, with all of the broad macro dynamics, what's the most compelling market for us? And I think it's still for us is that we should have a weaker dollar, and with that we should have higher rates in the U.S. And you haven't seen that trend of late, but like when we look and we run global portfolios, where are places more interesting? We like allocating money to the Australian rates market. We think there's a case in Canada because of kind of more clear deterioration. UK market is certainly a hairy. There's all sorts of things going on there, but there is some value out, I think, in the UK market in bits and pieces too. So
that was one of the contrarian trades from Bank of America and the fund manager survey. No one seems to like that market.
All I could say is even Christina doesn't seem to like it, even if she likes it. She's like, please, I understand.
You just have to be a little cautious, right?
Yeah, so it gives you a sense of where people are at with this one.
Just to pick up on this theme of a stronger economy, Scott Kirby of United Airlines speaking earlier this morning and essentially saying that the travel demand story for him this fall and going through the rest of this year is stronger than the broader statistics for the economy show, which again speaks to this retail sales print set against the weakness we've seen for payrolls growth.
If you want to go skiing, if you want to go to a beach, if you want to go to any vacation spot in December, take a look at plane tickets, and it will give you a sense of just how strong that demand is. That's my gauge, is to figure out how strong demand is by checking out some of the popular destinations and what the price tags look like.
Christina, what's your gauge? What anchors your view?
Look, I think there's some. It's interesting when we look at like planes and just some of the like, what do you feel when you're out there and seeing it? We talk about, and our team travels a lot internationally, the flights to London and back and forth, and that a lot of those flights are a lot more empty, and maybe you're not seeing, because of the change of the weakness of the dollar, you're not seeing as much international kind of travel. But I think you're talking about this tale of two consumers that we've had for a while here, and those that have money continue to spend and can be choosy, and you're even like you have like the trade down, and like if the Walmart's doing well, and it's just like a choosier. Where do I want to spend my money?
We've seen it for a few years, that's for sure. Christina, it's good to see you.
Great.
Thanks for being here. Thank you, Christina Campmany of Invesco. Coming up tomorrow, special coverage from the Bank of America trading floor. Look out for that at 6 a.m. Eastern Time. We'll catch up with Mark Cabana of Bank of America, Savita Subramaniam, Jim DeMar, and Brian Moynihan from New York City. This is Bloomberg.